Before I speak about the Savings and Investment Union and how Switzerland can contribute to it in a win-win situation, I would like to turn to the other side of the coin. There are always two things when it comes to investment: opportunities to invest in and people who do invest. The Draghi and Letta reports have laid out what needs to be done in Europe to increase competitiveness and growth. And they proposed a lot of important measures, and all of that will actually increase the investment opportunities. It will increase the supply for those who want to invest. The EU simplification of regulation push, the EU Green Deal and all of its financing, but also the EU research programs are very important measures to foster growth in Europe. And Switzerland could actually do a lot of these things too, because Switzerland didn't really grow on a per capita basis that much and shares actually quite a lot of the growth problems the EU also has. Sometimes I think, though, and when I reflect on yesterday's conversation we had with a number of people, that one doesn't see how much successful innovation actually does take place in the EU and how many winners they actually do have. And in financial services sector, names like Revolut, Klarna, and others come to my mind. And they are proof that there is actually a lot of entrepreneurial activity happening already. The other side of the coin, obviously, is the demand side. Who is to invest? And there is a big debate going on how you could increase that within the EU in the Savings and Investment Union by incentivizing equity investments through tax schemes, by building up pension models, pools of capitals, to finance all these opportunities which should arise in a more competitive EU. But there are external pools of assets. And so sits within the EU one of the largest cross-border financial market in the world, with several hundred of billion of assets, which could be invested in Europe if we were only allowed to do so. So that's why we lobby for years now, and we have come up with an approach which we call institute-specific approach, which proposes a harmonized EU-level framework for third country financial institutions to participate in EU's capital markets based on a license granted by a central EU authority. And under this model, institutions would be directly supervised at the EU level and subject to all the relevant EU laws. We think this is a super constructive approach which will ensure a level playing field, but at the same time it will enable a much broader range of investment products and services for the EU clients. We believe that this would really kickstart also a lot of innovation within the European Union. We have the opportunities to invest, and we have the pools of capitals which want to invest, but somebody needs to be in between and actually linking the two. And these are financial institutions which are experienced in asset management, in wealth management, in structuring investments, in bringing the two sides together in the most appropriate way. And that's what Switzerland can offer to the European Union, to the Savings and Investment Union, in a full win-win situation. Let me now turn to the conference of today itself. I would like to extend my sincere thanks to all our esteemed speakers and panelists. Your willingness to share your insight is really important to us, and we are looking forward to all your contributions. We are pleased to have with us today Rupert Schäfer, Executive Director at the BaFin, Germany's Federal Financial Supervisory Authority, with some indirect Swiss links. His remarks will set the tone for our first panel, which will examine how Europe's financial markets can adapt and thrive in our rapidly changing global landscape. Deregulation comes from certain parts of the world now, and we are interested to hear how Europe reacts to that. After the break, we have Jonas Stulz, Head of Asset Management at the Swiss National Bank. He will deliver a speech on the importance of euro-denominated assets at the Swiss National Bank. Swiss National Bank is a large euro investor with its balance sheet and reserves. To conclude the 9th conference, we have Laurent Ramsey, board member of SFC and managing partner at Pictet, who will share his concluding remarks with us. But first, it's my great pleasure and honor to welcome our two first distinguished speakers. We have Enrico Letta, former Prime Minister of Italy and author of the well-renowned Letta Report, and Colm Kelleher, Chairman of UBS Group since April 2022. Together, they will explore how the EU can build a globally competitive financial ecosystem and discuss actionable elements of the proposals from Enrico Letta's report. Thank you all once again for joining us today, whether in person or online. I wish you a very inspiring, engaging, thought-provoking conference and look forward for a really fruitful discussion. Please join me in welcoming Enrico Letta and Colm Kelleher.
Luckily for you, I actually won't be doing much speaking, as indeed all the content will be here. So what I'd like to start with is if we can recap the Letta report alongside Mario's report, and really for the benefit of the audience, the main conclusions that you come out with that, and what you think the most urgent reform should be as a result.
The main conclusion, first of all, thank you very much for the invitation. It's a privilege to be here, and I'm very happy to see how the Swiss financial world is active, proactive, and I attach great importance to what you can do also for this pan-European strengthening. I think it is absolutely crucial. First point, we have the euro, so we had the monetary union. It was a success, but we didn't have the same integration at the economic level. So we had the EMU in the 90s, great success for the M, absolutely not the same success for the E. My report is only on that. And it is very much focused on, first of all, creating the awareness of the fact that having the same currency doesn't mean that we have the same economic integrated system. And I focused on the three main subjects of the single market where the integration is not enough, and we are 27 and not one. And the three sectors are financial services, telecom, and energy. So the report is a list is a sort of roadmap for the three sectors where the E of the EMU is not integrated, with deadlines, objectives, and with a very strong, I would say, behavior that is not proposing any treaty change, but being very pragmatic, saying that we need to be effective very quickly, And that means that we have to work with the present treaties. So how to get this result in terms of integration of the three sectors without changing the treaties. And at the same time, the other big issue is how to eliminate this fragmentation that is vertical, the three sectors, but that is also horizontal. For instance, we have 27 corporate laws. We have, in some countries, Spain, 17 regional legislations and so on. That creates the problem of over-regulation and is a way for investors from abroad to say, oh, Europe is too complicated. And so how to get a result of overcoming fragmentation in terms of rules. There are some suggestions in the report. First is to stop directives and to move everything to regulations. Second is to create this 28th regime system to help in creating a sort of passepartout, a sort of fast track to avoid this fragmentation. There are other topics in the report, like, for instance, the fifth freedom, that is, in my view, maybe the other flagship I would like just to mention, and I stop here on that. Fifth freedom means the fact that the single market is well known as the market of the four freedoms. So freedom of movement of goods, services, capital, and people. It gives us the idea, the image of the economy of the last century. We miss the intangible. So how we can be successful in creating a fifth freedom and adding, without changing the treaties, it's legally possible, adding a fifth freedom and being able so to raise this flagship. Fifth freedom means the intangible, means innovation, knowledge, skills, research, and how to be good on that. Of course, there are many links with the other three subjects. First, the creation of the Savings and Investments Union that is fundamental to boost this very important fifth freedom idea. So this is the main aim of the report, and of course, starting from this awareness, there's the political big mission of the report is to say to the countries, hey people, we are all small countries in today's world, and we have to be aware of that. We are all small countries, so we have to integrate to be able to deal with the giants that are today the big protagonists at world level, and they weren't at the table because they didn't exist when the single market was created. So we created a single market in a world that today is totally different. We have to be aware of this difference. The difference is so evident. We, in Rome, just elected a pope. For the first time, the conclave was a conclave with a majority of non-European cardinals. 1 century ago, the conclave had an absolute majority of Italian cardinals. This is the evolution of the world. I hope Europe can be at the same level of evolution of the Catholic Church.
I hope so too. Now, it's interesting because last week I was at an investment conference where there was over $20 trillion of assets in the room, and there was huge debate about whether this time it's different for Europe. And you know the doubters, normally across in the United States, most of Britain, and then the believers who think there'll be some sort of change. It's interesting, you resurrected or brought back the Savings and Investment Union. To me, it's much more than a rebranding. Cynics are saying it's purely a rebranding and nothing else. And I heard this yesterday, by the way, from various people. And this clearly is going to focus more on the demand side of financial markets, including stronger retail participation. The European Commission has followed your recommendation and is pushing the strategy. What do you think we need to encourage that retail participation? Let's talk a little bit more about the 28th regime. And by the way, the momentum, the national governments, how do you make sure that at a national level everybody can pull together? Why is it different this time?
First,
Take an hour.
My first point on that is the following one. The Capital Markets Union failed for many reasons. As you know, I have a theory. The first, I would say, guilty is Brexit, because the Capital Markets Union was conceived 10 years ago with the idea to have London as financial capital of Europe. It would have been a great achievement, a great idea. Unfortunately, Brexit, as a collateral damage, had also the CMU. Today, the Savings and Investments Union is a way to take the integration of financial services from another angle. And the other angle is linking it to one of the big problems of Europe today, that is how to finance the big amount of investments that Europe needs for the big common goods. For these common goods, national money and national public money is not enough. These common goods are security, the transitions, how to accompany the transitions, innovation. On these common goods, we are lagging behind the US, very clearly, and we are lagging behind the US not only because of their strength in terms of public investments, as it was in the past, moonshot and so on. When you take artificial intelligence and space, you have on these two subjects an American leadership through private money. That is the big news for what I think. And we in Europe, we are not ready to do so because we have 27 financial markets and not one. So we are not able to mobilize and to scale. So the big difference with 10 years ago is that we are working, and we have to work on this idea of bridging savings and investments, creating a different momentum with the idea that it's something that of interest of the leaders. That was not the case before, because the leaders in the last 10 years had the idea that finance was always in the, I would say, in the image of voters, something linked to the disaster of 8/11. And so the approach of all the leaders was to say, I try to be very far from this topic. And it's impossible to get such an important result without the engagement of the leaders. Sure. You can give it only, or leave it only to ECOFIN. If you leave it only to ECOFIN, you'll never get the result. This is my experience in these years. You need to have the commitment of the leaders. And to have the commitment of the leaders, you have to explain to the people, and you have to be completely aware that having a strong European integrated financial system has a great impact for the citizens' life. And you have to explain it in terms of how to accompany the transition, how to boost innovation, how to be more secure in a moment in which security is becoming again a priority. So this is why I think this time is different, because there's an existential need for all the European leaders at the European level. And I am very happy because I saw the Commission very proactive and very fast in presenting it. The 28th regime is the way to try to create a European passepartout, a European fast track that is absolutely necessary. Because if we continue with this difference in the 27, we don't have a level playing field. There are so many differences in the application of the rules, nation by nation, or also region by region, because each country with its own specific approach, and is not just a specific approach, is a sort of inertia of defining the national system. Maybe just to provoke a small smile, I share with you my experience in someone since 3 months living part of my life in Madrid and teaching in a Madrid university, IE University. I rent a flat in Madrid, Chamberí, and everything very simple, very smart. Call center for changing the electricity contract. Very smart, everything very good, everything in English. So we are ready to sign. Please give me your bank account number and your telephone number, just few final details. I give my bank account number, I give my telephone number, silence on the other side. Sorry, I don't recognize this number because it starts with IT. He has to start with ES. I don't recognize this number. It has to start with +34. It starts with +39. We can't have the signature. You need to have a bank account with ES at the beginning, and +34 has to be your telephone number. Can tell you, Colm, that my first temptation was to say, please, I send you my report. I give you the demonstration that I can have electricity with my bank account and with my telephone number. But of course, it was not the responsibility of the call center. He was applying his rule, and it's not Spanish, because it would be the same in Italy or in France, of course. But this is the system. And the system, day by day, is a system protecting the national champions.
Sure.
And protecting the national champions, you limit them, because you limit them to become European champions. This is the main problem.
By the way, I had the same problem with my Sky account in Italy. But anyway, I want to talk about the EU-Swiss relationship. This is the Swiss Finance Council, of course, and you made some, the history of the EU and Europe, Switzerland, has always been somewhat checkered. You made some very interesting comments, if I can quote. Switzerland's participation in the single market through bilateral agreements further exemplifies the depth of integration and mutual benefit inherent in these cross-border partnerships. As a leading trading partner and source of foreign investment for the EU, Switzerland's engagement in the single market enhances the economic vitality of both entities. You then added that the relationship has been instrumental in areas such as industrial regulations, electricity, food safety, and could expand to financial services. Now, that's great, but then last year we were here and our good mutual friend Pascal Donahue was up on the stage, and we had a dose of cold water, if you remember. He said at the time, you're a third country, the UK is a third country, we have our own problems, we're not going to deal with you initially. Now, I think things may have moved on since then, and even he would say things have moved on a bit. What is your reaction to that?
Il se fait que je fréquente un peu Genève dans ce dernier temps, GESDA. And I have an approach that is a little bit different, but I think also the time we are living is different. And I think we have to start thinking that Switzerland, European Union, UK, we have to talk, and maybe we have to create a sort of pan-European system, because it is clear that the problems we are having are more and more similar. And what is happening with the US today is not something that is une parenthèse, qui va se fermer bientôt.
Sure.
We are at the beginning of the presidency. So we have to deal with, and the only way is to try to create a sort of pan-European discourse on that. It is not easy, we know very well, but in my view it is absolutely essential. I thank very much the Swiss authorities, the Swiss system. I thank you, Madame l'Ambassadrice, Adam, for the cooperation in the preparation of my report, because my report was a report on the single market, and the single market means that there are countries, the three, Norway, Liechtenstein, Iceland, there's Switzerland, and of course there's also a relationship with the UK. I was in London to prepare my report and to try to, I proposed, for instance, this on another subject, the creation of a common market of defense with the UK, Norway on board. That is, in my view, absolutely essential today. But on these topics, I think that the relationship between the EU and Switzerland can be a relationship very, very positive in the future too. And I of course, I follow the internal debate in Switzerland. I follow without saying anything because I think we have to respect. But I see some positive evolutions, and it would be positive for Europe. What is absolutely clear is that in the last 6 months, we understood that the world is no more Eurocentric. The world needs to have all the European actors, European, not European Union only actors, all the European actors together, working together with a different approach. And that is one of the new topics in the agenda, and I'm sure that Switzerland will be part of this discussion.
I'm going to ask one last question, and then we'll open up to some questions from the floor. And of course, being a banker, this is a totally self-serving question. You see what's happening with global regulation in banking, and I understand banking is only part of the deal, but we saw a headline in the US this morning, and I'm fully aware that there is going to be a restructuring of banking regulations in the US. Maybe not as extreme as people think, but definitely a lightening of regulation and emphasis being put back onto the regulated rather than the regulators. We've also seen the PRA being given a competitiveness mandate in the UK, which is that tension as well. We know in Europe there is huge debate internally as to what degree the regulators over-regulate within Europe at the expense of the politicians and so on. And let's not talk about Switzerland, because that truly would be self-serving. But nevertheless, what is your view on global banking regulations and what it means for the world, where we've already seen as a consequence of 2008, probably $45 trillion of assets leaving the regulated banking sector and going into the so-called shadow banking sector?
Yeah, you're totally right. We are still paying the price of the crisis, and if I may say very frankly, of the bad reaction that we had in the first years to the crisis. Because today it's a long time ago, 15 years ago, but the mistakes that we had in the first years of the crisis, I always remember, the biggest mistake was to start saying that all the politicians had as approach to say the crisis is a financial crisis. It's not an economic, it's not a real economic crisis, it's a financial crisis. So the people of finance will pay for it. That was the most, I would say, stupid approach possible. So in the first 2 years, 8, 9, the approach was always to say, okay, it's a problem for the financial people. They earn too much, and now they will pay. Some pain, it's good for them. Without understanding that the immediate consequence of any financial crisis goes to the real economy, then to social system, then to political system, because it is clear that populism was the ultimate consequence of that. So one of the bad consequences of that is the bad reputation of some of the securitization problem is still coming from that. And I think today there's the possibility maybe to move in the direction of changing approach to that. But what is necessary, I come back to my starting point, is to have a narrative and behavior and actions clearly telling that we think that finance is for real economy, and we need to link finance to the real economy, to SMEs, to big companies, to the way in which we need to invest in innovation and so on. Because if we are not able to create this new approach, finance for real economy, this is why I told you, Colm, at the beginning, we need the leaders on board. Sure. Without the leaders on board, it would be impossible. If it is a topic for people like the people in this room, it's impossible to get a result. We need to go out of this room. And it is absolutely necessary to be good in that and to be very focused, because at the end of the day, it is the big difference with the US is this point. And they are good in that, we are not. You add the fragmentation, and the result is a result in which we are becoming a colony of the US, and we are not able to boost innovation and competitiveness as we need.
I agree. Well, let's Look, there are a lot of things we could talk about. I mean, it's not just the financing of sustainability going forward, which was highlighted. It's also about the investment that needs to be made in AI. It's about whether you can attract and keep the candidates for those capital raising here in Europe. So with that, I think what we'll do is just hand over for a few questions, and we have a moderator on the floor, I think.
Good morning, everyone. Melinda Crane. It's a great pleasure to accompany you again. I'll be moderating the panels later on, but now, in fact, we do have time for a few questions from the audience. So if you have a question, and a brief question, please, because we do want to keep things concise and moving, then please indicate. So over here, and if you'd kindly say briefly your name and the institution that you represent, that'd be great.
Perfect. Thank you very much. Jules Landrieu. I'm representing Global Council. Just very quickly, I would like to have your views and thoughts on the current developments here happening in the EU bubble following the publication of your report. If you see that the progresses and recommendations that you've made are going in the right direction, and if not, what should be done to remedy that?
Thank you.
Positive and negative. Positive. I think the awareness is there today. Frankly speaking, but you mentioned what happened last year in your last meeting. There's a different set of priorities today in the Brussels bubble, and everyone at the end of the day shared this new set of priorities. The new set of priorities is around two words: competitiveness and security. These two words were totally absent 5 years ago. Totally absent. So I think this is a great result. And this is for what I think is the way in which Brussels works, the only essential precondition to be successful in the implementation. Because Brussels is not a DC. We don't have executive orders here. We don't have someone signing executive orders. All the 27 will be in a rebellion mode against this approach. So we need to have a consensus on a strategy. And today the strategy is there and the consensus is general. So this is the positive part. The Commission presented, and I would say, very surprised by the timing, presented immediately a plan on Savings and Investments Union. The Commission bought the brand. I can tell you that very frankly, when I wrote the last 2 days of my report drafting in April last year, I decided to bet on this new brand. I was, I would say, almost sure that it would be something very interesting for meetings, but not so concrete. So for me, it was a positive surprise to see the Commission buying the brand, because branding is fundamental in the Brussels bubble institutions. So that is the other big point. Big expectations and great interest for May 21st. You know that next week the Commission will present the strategy for the single market. Commissioner Vice President Séjourné is coordinating this work, and next week we will read the text. So, in my view, there's something very positive. If I may say, I add also the fact that the two presidencies of this year, Poland now, Denmark next semester, are working very well in having these targets and these priorities. And I think, and this is also my experience, my report column was a report where I have to thank the three presidencies in the period of my report. Sweden, Spain, Belgium. The three were very much helping, supporting, and the semester presidencies plays a role, an important role. I was lucky because Sweden, Spain, Belgium are three big supporters of the single market as a whole. But today, Poland and Denmark are working very well. Once again, we have to thank Trump, because to convince the Danes, I think the Greenland approach is very convincing, to convince the Danes to be very pro-Europeans, and I'm very happy to see that. Of course, I'm not very happy to see what is happening on Greenland. That is something that worries me a lot. I don't want to add worries, but I strongly suggest you to follow this topic, because in my view, in geopolitical terms, it can be the backlash of everything. On the negative side, or negative, I don't see negative, potentially negative side. I think we need proposals more ambitious in terms of targets, deadlines, because the member states will be very vocal in a positive terms, but in the concrete terms, they will try to stop. They will try to put obstacles on one side, on another side. Also countries that are very vocal pro the single market, but you can take a constituency pushing for that, another constituency pushing for that. So we need, from the center, a big boost. So I hope the Commission will be able, on all the subjects related to that, to put deadlines, clear deadlines, as Jacques Delors did. The great success of the Delors strategy in the 90s was always to say to the countries, you agree on the general principles? Sure. Okay, I put the deadline. And I say that the deadline, I share the deadline with all the citizens. Then is your problem if you're not able to get the deadline. I think this approach today, we have to rediscover this approach is the only one that can work.
Thank you.
Thank you. I have a question here.
So one last question, I think, otherwise I'm running way out of time. Yeah, so please.
Thank you very much. Hugues Sayard for Société Générale, French bank. Thank you very much, Mr. Letta, for being with us this morning. It's going to be a bit an overlap, I think, with the question that we had before, because I think it's also, we want to take advantage of your presence to have your thoughts on how this can be achieved. So my question would be, you mentioned how much the political buy-in is key at the top level. The leadership has to be convinced, and you mentioned how you thought things were changing in the positive direction in that sense. But what would be, in your mind, the main roadblocks, political roadblocks, and maybe enablers in getting to the result we hope for in the next 5 years? So, I mean, you mentioned some of them. I mean, Donald Trump is an accelerator, but what would be some of your key fears in terms of roadblocks and enablers? Thank you, sorry.
One, maybe I will surprise you, but one fear I have is excessive media and political attention and focus we are giving to the defense issue. Why I say so? For a very simple reason. Because I know how difficult it is to integrate the defense systems in Europe. It is very easy to say it in meetings, seminars, articles in the newspapers. When you go to the concrete details, we live in a system where we have 27 armies not talking to each other. We have 27 intelligence not talking to each other and spending half of their time to be in conflict to each other. We are a defense system in Europe that is not integrated at all. We have a defense industry that is starting now to be integrated, but it's very far from a true integration. So I don't want to be negative. I want just to say that if the defense issue is too much in the front line, the big risk of frustration is immediately there. Because we have great expectations, But I'm sure that for having results on that, we need time, because we start from very far away, very far away. We discuss about sharing the nuclear shield, but you come from a French bank, you know very well how difficult it is just to imagine that French shares the UN position that France has. That is that makes France unique in the world, in Europe. But it is clear that topics like that are very sensitive topics. So I don't think that on defense we can have very fast results. On the opposite, defense is always in the headlines, of course, because of Ukraine and because of what is happening, the consequences, and that. So I see it as a positive, negative effect, because it can be. I say that for a very simple reason. For my experience of European institutions, of European decisions, Europe has a big difficulty to focus on many different crises at the same time. So if there's one crisis, everything is focused on that. So if the front line is, the headline is defense, Ukraine, Russia, I think for all our discussions is a very bad news. Because the results on that will be very poor results in terms of integration. We need time. And at the same time, it will be very difficult to focus the energy, the political energy, on the other topics that are the crucial ones. And the most important one is the Savings and Investments Union. So is the creation of the integration of financial markets. And what I fear today is to have, once again, as I said before, this topic, left to the ECOFIN people. That is the bad news, and that would be the worst outcome. So I hope that Trump will continue putting pressure, but I think it's very easy because he enjoys very much to do so. But this pressure is absolutely fundamental. But also, I think for this pan-European discourse that I made, Trump was fantastic after 8 years of the worst divorce in history, to putting together the European Union and the UK again in a fantastic new marriage mode. So it's absolutely astonishing what happened. And I think maybe something similar can happen, maybe in a more Swiss way between Swiss and the European Union. So it is clear that we are all the Europeans on the same boat. We have to work together. We have to find a way to work together. So a pan-Europe at different speeds is today becoming something very. We have to update our thoughts on that, and it can be interesting. For me, it's a very creative moment.
Sure.
So I like it very much. It reminds me the fantastic moment, of course, in which I was 20, and I was very happy having 20. Being 20, the moment of the wall and the reunification of Germany, of Maastricht, and so on. But it reminds me some creativity of this fantastic moment, don't you think?
I agree. Look, I'm a believer. By the way, I didn't think of Trump as a Schumpeterian, but I'll think about that, right? I want to thank you for your service. We all want to thank you for your service. I think it's been an incredible report. We could speak for hours here, but Enrico, thank you very much from everybody.
Thank you.
Appreciate it. Thank you.
Good morning, everyone. A very warm welcome also from my side. I'm Esther Wittmer, the Managing Director of the SFC. Before we move on, I'd like to thank Enrico Letta for sharing this very interesting insights and perspectives, not only on his report, but also on other pressing issues that Europe and our sector are facing today, and obviously also to Colm Kelleher for this excellent moderation. Thank you to both of you gentlemen. And it's now my pleasure to introduce Rupert Schaefer, Executive Director of Strategy and Policy at BaFin. Rupert oversees a wide-ranging department that plays a critical role and is responsible for financial stability in policy at BaFin. Before joining BaFin's executive board in 2022, and there's the Swiss link that Marcel hinted to, he held several senior leadership roles at FINMA, the Swiss Financial Market Supervisory Authority. From 2015 onwards, he served as a member of the executive board at FINMA, first heading the Strategic Services Division and later on the Recovery and Resolution Division. We're delighted to have him with us today. Please join me in welcoming Rupert Schaefer.
Well, thank you very much for the invitation. It's really a pleasure to speak at this conference. And I think having a dialogue between like-minded partners is more important than ever. So we are experiencing really a time of uncertainty and radical change. Some call it turning points, in German Zeitenwende. And this not only presents risks, but also opportunities. And I will share some reflections how we, as Europeans, can emerge stronger from this turbulent time. And with regard to financial markets, two factors are decisive here. The first one is trust is fundamental. This is where we can secure a clear advantage in Europe by making no compromise on the resilience of our financial system, showing a high level of stability, predictability, and also legal certainty, and also valuing and protecting strong, independent institutions which follow a clear mandate. Second, we can show that Europe is increasingly attractive as a financial investment center, not only because the relative attractiveness is increasing, but also if we systematically reduce the complexity in regulation, if we cultivate a supervisory culture that is characterized by clarity, by speed, and also by responsiveness, and also then remove the barriers that stand in the way of a deeper, more liquid and integrated financial market here in Europe. And I will try to explore some of those topics in more detail, and I start with the resilience. Because over the last couple of months, I think we have seen that old certainties have evaporated in the financial markets. We have seen that the conventional wisdom that investors would always flee into US government bonds as a safe haven is not true in this case. So the understanding what safe haven assets is shifting. We will see if this marks a more deep paradigm shift. On the positive side, we should also recognize that the markets have worked well so far. So price formation was possible at all times. There were no liquidity issues. The margin calls were fulfilled. Financial institutions did not run into difficulties. So we experienced, I would say, more sort of an orderly disorder. And the question certainly is, where will it go from here? Of course, escalations are always possible in the trade negotiations. There's the question if the US would try to somehow weaken the US dollar. So in the end, we don't know what's happening next, but certain is the US dollar remains the anchor of the global monetary system, and this means that the US Federal Reserve is acting as the ultimate lender of last resort and really providing this sort of public good, and it would not work in the current market structure without it. So any idea, and sometimes you hear, that's why I mention it, that we should decouple from this is, I think, a very bad idea, and it's just not feasible. So at the same time, we should, of course, see the risks, and liquidity mismatches are a topic we should have in mind. More broadly, I think we should better understand geopolitical risks, geopolitical risk as a driver behind the more traditional financial and non-financial risks. We have to better understand, I think, also critical dependencies. And in the financial sector, we know that in part of the financial market infrastructures and also in maybe third-party tech providers, we have such dependencies. So trying for private sector and for public sector to have more optionalities I think is important, and we should start doing so. Now, turning a little bit on regulation and supervision, I would say that regulation and supervision in Europe has worked well over the recent years, and that's a strength we should really preserve. This is particularly true for the capital and liquidity requirements that we have now. We think that the regulation and the calibration is in principle, is right, and it has provided us stability in those turbulent times. So we should not change it fundamentally. And maybe on the Basel endgame, because that's a topic certainly for this room, I would add that we should maybe follow the Swiss example and implement this as planned. At the same time, I think we should keep in mind that having institutions like Basel Committee is really critical, and together with UK and Swiss partners, we should do even more than before to keep those institutions protected. So I think we have a positive note here. The financial system is resilient, and it should stay so. And there comes now the question of the opportunity. And because we are not a politician, BaFin is a regulator, a supervisor, I will try to make maybe some more practical proposals, how we can improve, how we can simplify, and how we can reduce the complexity that we see today in European financial regulation as well. I think the objective is very clear. We do not want to have ever more detailed rules. So less rules-based regulation, more principle-based regulation, I think would be a good start, because it gives more room for maneuver to companies, to the management of companies. It gives also more room to supervisors, so that we can react more quickly to new developments. The next objective, I would say, is more efficiency in terms of proportionality. So having rules that are appropriate and manageable for all types of institutions of all size would be very important. Now, before we point to others and come to maybe to the EU level, I think we have to look a critical look also in the mirror. So I can say also for BaFin, for our national regulation, we have to improve there. We want to reduce the complexity that is in the system. And we have also launched some initiatives. One is around small banks, and probably you are familiar with the small banks regime in Switzerland, which is providing quite interesting inspiration to us. And I can also say that the new government in Germany really has a focus on reducing this complexity and also modernize in a more broad way, I think, how the administrative state is working. And that's certainly decisive. So now coming to EU regulation, I think here there will be broad agreement that, of course, we can reduce complexity. But how can we do it in practical terms? I think that's the critical point. Now, maybe we should start with new regulation that is currently being implemented. And a very good example would be, I think, the AI Act. So it's an important piece of work. But we know that financial institutions are already regulated. So operational risk management is already part of the rule set. It's already part of our supervisory work. So we think, for example, here we only need new rules if there are specific risks that are not yet covered. We shouldn't just have a duplication of rules and a duplication of supervision in this important area. Maybe next example would be that before we try to refine existing regulation and making it ever more granular, we should ask ourselves, are they necessary? And a good example here is the green asset ratio. I think there's broad agreement that it's not really working today, but before we try to find a better definition, maybe we should just skip this rule altogether. Now, the level 2 and level 3 question. I think that's very heavily discussed, and we are involved in those work streams in the European supervisory authorities, and I think we can confirm it's just a very, very heavy workload, and it's probably just too much. So I would start with the proposal to have less delegations in level 1, less delegation for level 2 and level 3 work. And in particular, wherever you do not find a political compromise on difficult issues in the parliament, don't send it to the technical level because it will not work there. So having less delegation would be a start. And then for level 2 and 3 in general, I think we need better prioritization. What are the key projects? We need more risk-focused. What are the relevant topics we want to cover? And we need less detail in the rulemaking. And I think in the end it can only work if we have a better governance around the whole process. So better delegation, better control from the Commission, better control from management, what comes out of the technical work. As I said, we are part of this process, so that's our ambition. We will try to influence the work in this way. And maybe just to be transparent here, level 3, for example, is a comply or explain approach. So we take the liberty that as an exception, if we don't achieve to make the level 3 more risk-focused, we would also say, well, we will not implement it in our jurisdiction if this is not suitable for our market. So maybe then moving on to level 1 again and to the bigger ideas that we see for simplification, for reducing complexity. One, I think, is around the structure of capital requirements. We have in Europe quite a complex implementation of the Basel framework, also of the FSB TLAC framework. We have quite a series of different capital stacks and different layers in the stack. And there, I think we can reduce the complexity without changing the calibration. That would be an area for further work. Securitization has been mentioned, and I think we fully agree. We can reduce the formal requirements. We can reduce the costs of securitization. When it comes to capital requirements, we think that this should remain risk sensitive. So we should not really artificially increase the attractiveness of securitization. And then maybe last but not least, the question of third countries. It's a political question, and it's not for us to decide on that. But whenever you decide to give market access, really to have the full potential of the European financial market, then it needs to be in a very efficient way. And there, I think, is really room for improvement. So you should have a framework which is much more efficient in the practical implementation as we do have today. Now, maybe you can say that having those granular rules on level 2 and on level 3 is necessary just to achieve the supervisory convergence and also have the single market that we want to have in the end with a level playing field. And don't get me wrong, I think this convergence is extremely important and we need more of this convergence. But I think having ever more detailed rules is not the right approach, not the right way to achieve this. And just to give you this example of MiCA, that's the European regulation for crypto assets, we have over 50 level 2 acts. I mean, this is still quite a niche market for financial sector, but having 50 level 2 acts is just too much. And in the end, we don't see the supervisory convergence in this area. So this approach somehow has not really been successful. So more centralized supervision could be an option for having more conversions. But we think that should be only in some specific areas. And of course, we are biased a little bit as a national authority. But I think in the end, you should really clearly define what you want to achieve. And if you want to have more efficiency, then EU centralized supervision can work in certain areas. And I mean, the supervision of CCPs is probably a very good example. But if you centralize, then keep in mind that probably the national level will still continue to exist. And as we see in the SSM, which is, I think, overall a good approach and a good success, you have to make sure that this coordination between the national level and the EU level is really done in an efficient way. And you need also governance on EU level that is, I would say, efficient and also lean governance. So, ladies and gentlemen, let me conclude. I think that turbulence and upheaval brings opportunities, as it does bring risks. And it's in the end to us what we make of them. And we all know this famous quote from Jean Monnet, Europe will be forged in crisis. I think we should not wait for the next crisis or for real crisis. We should more follow the motto of the previous panel, which was turning vision into action. for a more resilient and also a strong financial center in Europe. Thank you very much.
Thank you. If you would kindly stay there just briefly, because I know that we have at least one question in the audience, and I think we do have still about 10 minutes left. So Lukas Gevila, I think, has a question. I'll just get you a microphone, Lukas. One moment. Thanks.
Thank you very much. Lukas Gevila from UBS. It was actually very interesting listening to your description of what's going on and also the reforms that you're intending to do. My question is, if I read the Financial Times this morning, and there is the headline, the US is poised to deal back bank rules imposed in the wake of 2008 crisis, and I listening to Enrico letter earlier this morning where he said, we should start to realize that 2008 was not primarily a financial crisis, but it was actually also an economic crisis. And as we know, and you were referring to it, you can have executive orders in the US and things go very fast. So how do you think Europe would, counter such a spearheading of the US, which would then bring them again ahead of all other financial centers?
Sorry, thanks.
Well, first of all, I think we should wait and see what really comes out in the end, because there are a lot of proclamations, a lot of ideas in the US. We are discussing these issues directly with our counterparts, and I think this commitment that the Basel framework is the right one and that the US will implement is still existing. So, and the second remark would be, we should look at all the rules if they are really achieving the objective we intended in the first place. And I think many of the rules, having more capital and liquidity buffers, are important and have proven very successful in the recent turmoils, be it COVID, the pandemic, but also now in April this year. So dialing back there, I think would be a mistake, because we need the resilience of the financial system as a basis to have economic progress. But we should really look at the complexity. We should also look at some rules that maybe don't work. But in general, just to say we have to lower the capital and liquidity standard, I think would be wrong signal and the wrong decision.
Thanks very much. I think we would have time for one more question. Over here, sure.
Hello, thank you very much for your comments. This is William Wright, founder and managing director at the think tank New Financial. Rupert, I'm just wondering if we've seen this process of simplification, decomplexification going on in the UK regulatory framework over the past couple of years. I'm wondering if you think there are any lessons, anything that the EU and member states can and indeed cannot learn from that process.
We can always learn from comparing our rules with other jurisdictions, UK, Switzerland. And if you look at the regulation today in place in UK, I think it's not totally different. So there are more specific changes, and that's what we should do here in Europe as well, reducing the complexity and being inspired by other jurisdictions. So the UK is a partner for us, but it's also a source of inspiration as Switzerland. And at the same time, I think we have in some parts in Europe also regulation that can be inspiration for others.
Thank you very much to Rupert Schäfer. Officially now, good morning, everyone. I'm Melinda Crane, and it will be my great pleasure to accompany you today as panel moderator. And it's a pleasure to launch our first panel now. The title is Shaping Europe's Financial Markets in a Changing World. And In fact, we have been talking about shaping more deeply integrated, interconnected capital markets for 10 years now, since the launch of the first CMU action plan. And at least from the perspective of an outside view, it sometimes feels like we did more talking than acting. But as Colm Kelleher and Enrico Leto pointed out in their dialogue, this moment is different and it is also critical. It's not too much to say, I think, that mobilizing capital for investment and innovation has never been more critical for Europe. So in our first panel, we want to ask whether geopolitical and geoeconomic challenges are in fact driving a new impetus to move forward on SIU and explore solutions for strengthening the vitality and the interconnectedness of financial centers in the EU, but also in the UK and Switzerland. It is my pleasure now to welcome our esteemed panelists. I'll introduce them one by one and ask you to join me as I do that. Raffaella Assetta is head of the International Unit of the European Commission's Directorate General for Financial Stability, Financial Services, and Capital Markets. She previously served as deputy head of the DG FISMA unit in charge, this one right there, in charge of monitoring the implementation and the free movement of capital. It's wonderful to have you with us, Raffaella. Thank you very much. Virginie Etienne is with us. She's head of offering and regulatory change at Julius Baer, Europe. She's an executive director of the bank, and she works on regulatory transformation projects. It's a very small stage, so if you would please take the seat next to Raffaella, on regulatory transformation projects and supports the bank's sustainability initiatives as sustainability officer. Boris Kiselewski is head of the European Central Bank's representation in Brussels, serving as its principal advisor to the European Union. Welcome to you. And next to Virginie, if you would. And finally, Thea Utoft Jensen, hopefully I more or less pronounced that correctly, is Director General of Insurance Europe, the European Insurance and Reinsurance Federation. She previously served, among other posts, as Financial Services Counselor for the Danish Permanent Representation to the EU. Welcome to you. Oh, last one, please. Thank you.
Start with the balancing act, huh?
So great to have all of you with us. And I'd like to start out by looking at some of the headwinds that Europe's financial markets are facing, with geopolitical tensions on the rise, shifting investment patterns, trade alliances, and monetary policy decisions, all of which will impact, of course, global capital flows. But regulatory shifts and rapid digitalizations are also posing challenges. So there's a lot out there that obviously can create risk and uncertainty. And Raffaella, if I may begin with you, the new commission has renamed CMU. It is now the brand that Enrico Letta recommended in his report, and indeed that has had, I think, a real impact on perceptions of what this could mean. Would you say that rising geopolitical tensions are in fact impacting the political will to move forward on this project, both in Brussels and in member countries? And what do you see as most crucial for addressing the challenges?
Thank you very much, and thank you very much for having me, first of all. So it's a great pleasure to talk to you. I will echo what was said in a way in previous intervention. I think that there is a stronger case for the Saving and Investment Union in this geopolitical context. So let me first say, if you allow me, it's not a rebranding. It's something different and more holistic approach, which encompasses both capital markets and banking, because banks also have a big role to play in capital markets, and they are crucial for intermediating saving into an investment, into investment needs. So this is something I would like to stress. Now, for me, the geopolitical context and the uncertainty in the economic developments reinforces the case of SIU. Why? Because investors are looking for safe places to invest. And the EU is seen by third country jurisdiction, first of all, as a reliable partner, which is good, and as investor, increasingly as a safe place to invest. Now, with the SIU, the idea is exactly to create the condition to increase investment opportunities and make this market even more attractive for foreign investors. So it's a great opportunity. Now, what are the challenges? I would say, I will mention two aspects. One is what to do, and the other one is how to do it. What to do, crucially, as you mentioned, we have been working for more than 10 years in creating a single market for financial services. This is the challenge. Remove inefficiencies, remove barriers, national barriers that makes inefficient cross-border provision of financial services, cross-border business. So this is a big challenge because it implies looking into topics that we have not really touched upon for a long time, and they are politically sensitive. This goes from taxation to insolvency regimes to supervision, where we have made big progress, but more progress needs to be done. And now we think we have a political momentum to go into that and to make progress. Second challenge is on how to do it. We need the right approach. And as I think Mr. Letta pointed, this is not something that can be done in the Brussels bubble. We should reach out to also at the national level, listen to member states authority and stakeholder, which is something we have been doing to get feedback on what exactly needs to be done to make it happen.
Thank you. And I want to pick up on that a little bit later in our second round of discussion. But I'll jump over now to Thea Utrecht Jensen, if I may. And where do you see the greatest challenges from the point of view of institutional investors? What structural reforms would you say are essential to enable insurance firms to channel capital into EU markets more effectively? There's a big pool of it out there, and yet it doesn't seem to get channeled to the degree that could be.
Well, I think the first good news is that we actually agree with the Commission about a lot of things on this one. Because first and foremost, it is a matter of increasing the retail investments, and either directly or through intermediaries or institutional investors within the capital market. So it is about increasing the flow of money into savings and retirement products, and then from there into the capital market. If you look at the institutional investors, I think there's several things, and as you rightly say, it's the what and it's the how. But I think we've identified that there are several categories of assets that infrastructure, private debt, private equity, venture capital, listed equity. Well, the list is long. I'm not going to enumerate all of it, but it can be really hard for us as insurers to access due to a lack of sufficient scale and a lack of information about these assets. Secondly, you touch on the cross-border investments. I think that's a very important thing to tackle. Taxation, yes, but also insolvency. And we know it's a difficult thing to do. I don't think that should discourage us from actually trying to do something about it, because ultimately, if we didn't do the difficult things, we wouldn't be in this room, and Mr. Letta would have spent a lot of energy on writing a very visionary report about the hard things that we need to do. We need to have the courage. So I applaud the Commission for having the courage. And then I think looking at it from a heavily regulated industry, excessive capital charges, especially on assets like long-term equity. Equity investments are quite heavily taxed on our capital charges, and it makes it difficult to put something into it. So it acts as a barrier to put money into these things. I think structural reforms, well, I think, again, the Commission's doing something good by aligning the EU public funding instruments with the SIU objectives. And we believe that that actually is going to be a generator of further, let's say, not crowding in, but at least further attention. We believe that there are some things where these risk takings by public instruments will allow us as institutional investors, but also others, to venture into those areas of SME equity, SME debt. We would want to, we actually advocate already quite a lot. We'd like to see more public-private partnerships. We need to explore that vehicle to bring more capital into that. Looking at, we actually have a lot of national inspiration to build on. There's a lot of very strong national examples of funds, like in France they have the TP fund, there's a growth fund in Germany. I think there are a lot of things we can learn from these. Maybe it's not a pan-European fund, but maybe it's a matter of learning from each other and thereby increasing the depth and the width of the market. Mm-hmm. Cross-border investments, for sure, and then the prudential rules. But again, these are my three kind of key things. There's a lot of devil in the detail there, but I think something that's on the table already, let's get a Solvency II delegated act that fits with the purpose of Solvency II. That's a very good first step.
Virginie, regulatory burdens were a central focus of both the Draghi and the Letta reports, and Rupert Schaefer mentioned just, 50 different acts related to crypto, was it? Or, yeah, as just one example amongst many. What's your perspective on the current regulatory environment and how it affects the attractiveness of the EU as a financial hub compared to other global markets?
Well, thank you, Melinda. I think that's an easy one. It's been told already today. Our regulatory framework is overly complex and need to be simplified. So I'm certainly not here to summarize the Letta and the Draghi report, but I will only mention two challenges which are well documented within. So we mentioned the 50 level 2 acts for MICA. Do you know how many new acts have been published at the EU level between 2019 and 2024? So according to the Draghi report, there has been 13,000 of them in 5 years' time only, excluding any national law. And during the same period of time, in the United States, there was about 5,500 new acts adopted at federal level. So that means that during the same period of time, our European companies had to deal with more than the double of new rules compared to their US competitor. And all of that happened before the new administration took place. So that's the first challenge. Second challenge, already tackled, but I think worth repeating, is that in addition to this, our companies also have to deal with those duplicate rules and lack of harmonization, so making any cross-border business even more complicated. So to come back to your question, what I think of our framework, well, we have a lot of rules. The framework keeps changing, and it's not harmonized. So in my line of work, as I'm tasked with regulatory changes, it's a very good news. But on the broader scale, we can and we should do better, particularly as it is costing us. That complexity is leading, contributing at least, to a profitability gap between the areas.
Can you just say a word more about what you would consider to be priority areas? And I'd love it if you would also reference your expertise in the sustainability area, because certainly when I speak with SMEs in Germany, where I'm based, that's one of the first things they talk about. The extreme, the granularity, the duplication, and the real burdens, especially for small and medium companies.
Well, I'm glad that you asked, because indeed, I think sustainability makes quite an interesting case study in today's debate. So, as I'm also acting as the head of sustainability for the Julius Baer Europe, it is clear that it is an area where we have room for improvement. And the need for green transition is generally well understood and accepted in the population. Yet, I think it's also clear that today we did not fully reap all the benefits that we're hoping for from the law. And here as a bank, sitting in front of the end investor, it is clear that it's overly complex. If I take the case of sustainability preferences, for example, we need to ask our client if they're interested in more taxonomy-aligned products, SFDR-aligned products, principal inverse impact, the kind of qualitative, quantitative criteria that they are interested in, we are losing them. And so as a result, the proportion of clients who have elected to have those sustainability preferences in the banking industry in general, so I'm not talking about Julius Baer only, it's disappointingly low. But what is surprising is if we do a look through, so we put those preferences aside, and we look at the proportion of clients who have actually invested into sustainable products. And here it is much higher. So we find ourselves in the awkward situation where we have investors who very obviously do have some interest in sustainability, and yet they voluntarily choose to opt out of the framework. And I think here, to bring us back to the debate, we need to take the lesson learned. So we don't make rules just for the sake of it, but for the impact that they have on the people and the economy. Mm-hmm. And that is what we need to keep in mind. So all the debate about simplification is very important, but we should also make sure to keep it real and effective.
Yeah. That, in a way, echoes what we also heard from Rupert Schaefer, doesn't it, about the need for principles-based regulation as opposed to, and flexibility. Let me go to Boris Kiselewski now and ask you to share your perspective on the impact of rising geopolitical tensions and economic fragmentation on Europe's financial stability and resilience, and how important capital market integration is in that context.
Thank you, Melinda. Good morning to all. Well, first, the financial sector has remained resilient over the reforms of the last 10 years. We have robust capital and liquidity positions, especially also since the setup of the single supervisory mechanism 11 years ago. So we are sort of confident that we are ready to withstand shocks. But of course, we as ECB, we remain vigilant and active. So yes, I agree that looking ahead, we should, of course, now move into the implementation phase of the Savings and Investment Union. And it's really Europe's moment now. We can, not only the central banks, but also governments, we should really move into accelerating the pace for implementing. So where do we come from? I have a few, say, striking figures, which is always good to start with. As you know, European savers save much more, so 15% of disposable income, Europe against 8% in the US. And we have about 11 trillion in cash deposits, which is 1/3 of total households compared to 10% in the US. And so if the EU households were to align their deposit to asset ratio to that of the US, we would have a stock of 8 trillion that could be redirected to long-term financing, and which means 350 billion annually. So these quite staggering figures, and this money would be much needed to finance the twin transition and to also foster our capital market union. And of course, this means that we have to increase the risk-bearing capacity. So that said, it's what can the ECB do? What are sort of our contribution to this debate on SIU? I would say it's threefold. So first, it will not surprise you, of course, our main mandate only needly on compass is price stability, to ensure price stability. We are 2.2% in the euro area in April. So that's really good that we are fulfilling our mandate. The second is the strong and intrusive supervision of banks. So let's not forget the 2023 US and Swiss turmoil, which the euro area passed with flying colors. And so now, coming back to your question on geopolitics, also the SSM is engaging with banks toward improving their asset, their management capabilities of geopolitical risk. So this is really important. And the third element is on precisely SIU. There's been really a lot of talk about the need of saving investment union. Fully concur, of course, with the Commission proposals, and we are trying to also contribute concretely to the debate beyond, let's say, the words. And so we at the ECB, we have identified 3 areas where we should make progress, and we are ready also to engage. So first is entering the capital market, so meaning, and this was already mentioned, meaning to bring, to work on one savings product, or at least a label for a pan-European savings product. So this is, let's say, an important element. Second, expanding. So here there's a lot to do, and my neighbor mentioned it also on trading and post-trading, and the CSD supervision, which Mr. Schäfer also mentioned before, and you will also not be surprised that for us, supervision is an important element looking ahead, even though it might be politically charged, and the upcoming securitization. So this is the expanding part, and then we have the exiting part, and there, of course, with towards our US competitors, we have the issue of venture capital financing, which is not deep enough. So this is something on which we as ECB also do some research and would be are very happy to contribute to the debate to make it very concrete.
Thank you very much. And I'm glad you talked about that huge pool of savings because, in fact, that is one of the reasons often cited for the advantages of having savings in the new name, to remind people that household savings count. Let me just ask you, if you would, to say one word about convergence, because Rupert Schäfer talked a little bit about that, and that is seen as one of the key building blocks to getting toward a viable capital markets union. And again, it's something where progress has been made, but there are still some substantial hurdles there. Could you just say a word about that?
No, you're right that we are still in the phase of excessive fragmentation, and this is exactly the purpose of making convergence. So there could have to be convergence supervision. So this is something which has to be a first step towards a more unified supervision, that's for sure. And then I agree also with my neighbors, speakers on the issue of the frameworks for insolvency. So there, of course, it's a very big debate. It's extremely complicated because it should be a long-term goal, but we have to start now with very concrete steps on moving on the convergence of this insolvency framework in Europe, and we know it's also difficult because we are more, let's say, on the financial track of Brussels, and this depends more on the legal track, the justice ministers, and then to make the finance minister and justice minister talk and work together is a challenge sometimes, but we have to keep on going.
Thanks very much. Let's do a second round of discussion, and then if we have time, maybe we'll take just one or two audience questions as well. But I'd like to talk about what all of you, representing very different stakeholders, can do to enhance EU competitiveness and innovation in the financial markets space. So whether by fostering technological advancements, streamlining regulations, promoting sustainability in a more efficacious manner, whatever it is. And again, I'll start with Raffaella, if I may. There is wide agreement that streamlining and simplifying regulation would improve market agility and competitiveness. What is needed to actually make this happen? The Draghi report had an enormously long section on this, and clearly there's a lot to do, but what would you say is critical?
But willingness to act is critical, of course, and I think that the Commission is willing to act. Simplification and burden reduction is one of the core priorities for the new mandate. And we have already started doing that. So determination is there. We have already started, as you know, as a first step with this, with the proposal on the simplification of the sustainability reporting requirements and due diligence obligation. So this is something we see as a first step and that we'll continue doing. So determination first thing, listening to the market is to me is a second important thing. So we have listened to the market while in this effort to simplify the sustainability related reporting. Why? Because we have been front runner on that. So we have been in the EU the first one to put in place a comprehensive sustainable finance framework. Then it has to be tested. whether it works, to what extent, what works well, less well, what can be streamlined, potential in overlaps. So all of these, we are ready to look, and we have been looking at that. And the proposal, the so-called omnibus one, with a strange term, but this is the idea, is to look at the whole framework and see how we can streamline, listening to the market. So then we can give to the market back time, potential to make their business stronger and power in a way. And we will continue with that, I think.
When you're listening to the markets, what do you hear in terms of what would be most essential to make European capital markets more attractive also to foreign investors?
Well, the key thing I mentioned already is to reduce fragmentation. I think that the foreign investor often see the EU not as a single market, but as a collection of different small national markets which are less attractive. So it was mentioned clearing and settlement. I think we have 26 central securities depositories and 14 central counterparties providing settlement and clearing services. Now, may be good, may not be good, but from the perspective of foreign investors, having such a fragmented market prevents building up scale and result at the end in higher cost, and then they will be passed on also on financial users. So I think that this is an important point that the SIU project also aims at tackling, which is removing legal, operational, and technical barriers that market participants face when operating cross-border. Just on this simplification agenda, just something else I wanted to point out is not a deregulation agenda. So that's, I want to be clear on that, because it was mentioned also resilience, and of course we want to simplify, we want to reduce the burden, but we need to preserve also strong consumer and investor protection and financial stability. So the question is striking the right balance and finding rules which are proportionate, as was said, but still help us maintaining a sound and resilient financial system, which at the end is essential for competitiveness.
And I'm glad you mentioned consumer protection, because actually when I think about that pool of $1 trillion, was it, that Boris mentioned, of household savings that don't get channeled into capital markets, clearly trust is essential. And what would be needed to build the kind of trust on the part now of domestic investors, of households, to actually enter capital markets, those people in Germany with their savings in their mattresses?
Yeah, that's a very good question.
Or their Sparkasse.
I will try. I struggle to convince my own parents to invest in capital markets. So I know it's difficult. I think that financial education is something we should pursue. It is very important, and in a way, I think that the branding helps. So if there is a product which is widely recognized as being safe, a EU brand, that may help, probably.
Thank you very much. Let me jump over now to Thea again and ask you how Europe's insurance and pension sector can contribute to deepening capital markets and getting that longer-term investment pool that you mentioned. What can you concretely do?
So the industry plays that key role already, or can play it even more in 3 areas. We have 3 core activities. We provide the security that is needed for people to take risk and do economic activity. You need an insurance to have a small business. You need an insurance to start whatever kind of project it is you do, and that's one of the core activities of the sector. We also provide you talk about savings and retirement. We provide a lot of products that actually serve the retail investors to help people save, not in banks, but in another way. And we invest in the economy as institutional investors. So we basically generate the connection between if your parents don't want to invest directly in the market, they can have a savings and retirement product with the insurance industry, where we then are able to channel that pool of funds into the market. So just to give, I want to come with some numbers as well. Don't want to be in the shadow of the ECB here. We manage over 9 trillion euros in assets. The majority of that, about 69%, is invested in Europe, financing critical infrastructure, green and digital transition. So last I checked, that's very SIU aligned. We also allow for people to not be over-reliant on the banks. So we invest on behalf of policyholders and beneficiaries in a variety of different products in the capital markets. So we are broadening the investor base, and we are also supporting risk sharing across the economy. I think when it comes to boosting retail participation, we are, again, we're providing a specific type of products that is for the less risk willing retail investors or savers. You're able to save for your old age or for protecting yourself against, not having a job by using insurance-based products. And again, coming back to the numbers, EBIPS, which is a very popular product, actually at this point is estimated to represent about 70% of the retail investment market. That's quite significant, and it's a product that allows you to, as a consumer, a retail participant in the market, to have a product that fits your appetite for risk and still provide you with a very high degree of protection. And there's loads of things about that safety, and you talk about trust in the market, trust that you will have benefits from your investment saving activity. I feel the industry plays a crucial role already. We may not have been good enough at talking about it, but we definitely are doing a lot of these activities. And I think financial education, I couldn't agree more. I think there's a lack of understanding of the variety of products and advice and distribution channels that is available at European level. We find the label idea very interesting, but I think we have to not repeat the mistakes of the past by being too prescriptive, so that we end up having a directive or a regulation that covers one project across Europe.
Do you see risk aversity or risk willingness changing now amongst younger Europeans? And are there some countries where you would say the consciousness, we could learn something?
So it's interesting you ask that, because we are actually working with the European Youth Parliament, which is an organization that gathers European youth. I think they get kicked out when they're like 21. So they're really young, like properly young. And one of the things that we've been seeing is that the more we talk to them about pensions and the more we talk to them about insurance, they stop seeing it as something that's boring and dusty and actually understand how much of a quality of life these products can give. But I think it is very much about having the courage to engage with them at their level. If you look at finfluencers, if you look at the conversation that is available on TikTok or wherever they find themselves, there's very little that talks about the boring products, but a lot of conversations about the more risky products. So put your money in crypto, put your money in, and then I'm not judging one sector over another, but I think we're missing part of the picture there. There's a lot of interesting national savings investment projects, but I think it's important to realize that how you deal with your money is very cultural, and usually it's something you've been taught by your parents. How do I get the advice? Do I go down in the bank? Do I talk to the intermediary? Or do I ask my friends?
Mm-hmm. Interesting. Virginie, the role of private banks and wealth managers, how do you think they can catalyze this deepening of European capital markets? What's the role that you would say Julius Baer, for example, can play in this, also as a third-party entity? And what measures would contribute to furthering market integration and resilience?
So how can we help? Well, I think I would like to challenge a little bit the question here and paint the perspective from the bank. We discussed about the institutional investor, and I think there is clearly a lot of opportunities out of using the private money, so the individual who are ready to invest, in order to channel it into the growth and development in the EU. But as a bank and wealth manager, there is also so much we can do. And we need to act within the boundary of the legal framework that we are being given, and we also do have a fiduciary duty toward our clients. So to take the earlier discussion we had about sustainability, we can and we should ask our clients whether they have any sustainability preferences. But we cannot make that choice on their behalf. And looking forward, we will not be able to advise the clients to invest in a product that is aligned with the EU objective if that's not in their best interest to do so. So here, maybe in some sense, actually to all of you here in the room, I think it is us who need your help. We need to build a framework that is attractive and conducive in channeling investment where they are most needed. So, about what can we do? That's a long debate. So I will maybe only use one example of area where we can do better. Also, jumping on what was said earlier about starting the simplification with the new regulation. So, in terms of changes, we have private market, we have the public market. So private market is a key vehicle in order to bring real changes to the economy. But today, private wealth is an under-tapped source of funding for those private market investments. A recent publication from Equity was talking about an average allocation of 3 to 5% only of private banking portfolio into private market investment. So that is very low, especially when we look across the borders to the US, when it sits around 10 to 40%, depending on the type of clients. So the reason why it are well known. On the retail offering side, it is quite limited. The regulatory framework is very complex, yet again. Markets are fragmented, so it's very difficult to scale up. So that means that today, investment in private markets are mostly limited to professional clients. And today, despite their wealth, despite their sophistication, our private banking clients still have a challenging time to be recognized as professional when they wish so. Here, the retail investment strategy proposal is certainly moving in the right direction. We are discussing about how to simplify some of the existing conditions. That's a good thing. But surprisingly, despite the talk on simplification, we are also bringing a new set of rules on the table. So tomorrow, legal entities might have to meet 2 out of 3 quantitative criteria, such as a 20 million turnover, in order to be recognized as professional. So that's something that does not exist today. And that will leave some of our clients behind. So I don't know if all of you are familiar with how the private banking operates, so maybe I will take a moment. It's quite standard for our clients, especially the wealthiest one, to decide to consolidate their wealth within so-called SPVs, or special purpose vehicle. So it could be because there is a large family behind, for efficient succession planning across jurisdiction and so on. So there's a lot of valid reason. Now the catch is, those entities are not operating businesses. They are a kind of wrapper that will structure the wealth. And so the quantitative threshold that they will have to meet tomorrow are just not meaningful to them. And so the danger will be to leave those clients behind, despite their eagerness potentially to invest. It will also lead to the quite strange situation where we might have an individual client meeting all the criteria to become professional, and yet, as soon as for efficiency reason, he or she decides to move those assets in the SPV, they will not be able to keep that classification anymore. So I don't really think that it's the outcome that we are looking for here with the proposal. And I believe that will be a self-inflicted wound that we can still change. So that's an example.
Thank you very much. And we will, in fact, come back to some of the points you raised in the first part of your answer in our next panel after this one. Boris, if we take a look at the innovation theme that was also such a major focus of, for example, the Draghi report recommendations for enhancing competitiveness, what role can the ECB play in promoting innovation in an increasingly digital financial sector? And particularly in regard to areas like central bank digital currencies. What do you see Europe's role is there?
Thank you, Melinda. It gives me indeed the opportunity to talk about our dear project, the Digital Euro, which, as you know, is being a lot discussed in Brussels. We have a legislative proposal from the Commission, and now the Council is working on it. Parliament is also looking into it, and we, as ECB, of course, are working in the system of central banks in Frankfurt on this very important project. So what is the retail digital euro? It's actually cash-like money. As you know, cash is declining. We just have to look at our children. And also, we just see that consumers prefer to pay digitally. Last year, for the first time, digital payments, so cards and mobile solutions, have become the most dominant payment instrument in Europe, in the euro area, 54%, up from 47% in 2022. So a digital euro would provide a solution for payment cross-border within the 20 countries of the euro area and strengthen Europe's sovereignty, because we would not depend, like now, on foreign-based providers, but we would depend only on our own technology and infrastructure. And also, it would be much cheaper for consumers because of the fee system. So I would say, coming back also to your first question on geopolitics, of course, the fact that the Trump administration is pushing the growth of dollar-backed stable coins worldwide, 99% of stable coins are issued in US dollars actually, is also an important impetus for us to come up with our digital payment solution. And so there have been some talks here in Brussels about financial stability. As you know, the digital euro would not offer any remuneration, so not make it so attractive compared to bank accounts, let's say, and also have a sort of a limit, a ceiling. Work is being ongoing now on determining the ceiling to really ensure that financial stability is also underpinning this digital euro project. So this is there's also an element of innovation, because through this digital euro project, it offers also scope for innovation for banks and payment service providers that would benefit from a solution that pan-European and less costly than current foreign-based solution. You see who I have in mind. And so we are quite working hard on this project, and here it's important to mention it in Brussels. And I'm very also grateful that the Draghi and Letta report mentioned also this project as one example of where Europe can lead in terms of CBDC, because as the BIS has mentioned, many central banks are working on CBDC, but we as ECB are sort of a front runner in this project.
Thank you very much. I want to do a final round in just a moment, but I thought maybe we would take this opportunity to take just a couple of audience questions, if there are some in the room. So if you have a question, please raise your hand, and a microphone bearer will come to you. Anybody? Everybody satisfied so far? Not a single bit of curiosity? Oh, please. Okay.
Thank you very much. I'm Carlo Brenner from Citibank. Maybe I stand up so you see me better. And my question is actually on, I'm a bit confused over the SIU, because I see a great divergence between the narrative of the institutions that we spent months hearing that there was a political momentum on the SIU, and now that we come to the facts after the proposal in March 19, that we see that there are a lot of political divisions. So my question is, where is the political momentum? And the question, especially maybe for the Commission, but also from President Letta, if he wants, is about, and for the panel in general, is how do you see solutions of cooperations of states? That is something that the European Commission cannot do itself, but maybe like an enhanced cooperation for some member states to propose savings and and investment products themselves on a smaller scale that then could be extended? Thank you.
Thank you. So, Raffaella, the first part of that question, in a way, goes to what Enrico Letta said in the discussion preceding, when he said, now it's going to be time to set the deadlines and the targets.
No, indeed. I mean, clearly the political momentum is there, but clearly also there are resistances. So that's why the Commission approach is indeed to be very ambitious in what we propose. I'm not saying that the discussion will be easy, because they will not. But we need to come with a narrative which points to what are the potential advantages. And in a way, we also need all the relevant players and stakeholders to push for this. I mean, the figures that Boris mentioned on what we could achieve if savings were channeled into capital market are amazing. So they should be enough to convince our political masters. So, and that's why we put forward proposals that are ambitious. At the same time, of course, we have a better regulation process to follow. So we look very carefully at what makes sense to do. We cannot be overly ambitious just to get a middle result. So our proposal should make sense, and then should be defendable and well-grounded, and taking into account also all the interests that are at stake, of course.
Thank you very much. I'd like to ask the rest of the panel if you want to weigh in on the second part of that question about how could member countries and or other actors work together bottom up. And I'm thinking of something that I believe it was in the Commission's announcement about SIU, where they talked about even convergence. We need to start working from a bottom-up approach rather than always thinking top-down. So perhaps that's something, Boris, you would care to say a word about.
I think indeed that in 1 month we'll have the concrete proposal on securitization. Some in this room pointed at the low-hanging fruit. Let's see. But I think it will be a very important moment also to see how the member states should come together and how we move on this we can call it not too difficult item to start with. So I think it's very good to start with securitization, and then to roll over. I think everybody is convinced now. So from bottom up and top down, we have to merge these two sort of ways to do it. And we as ECB, instead of having a shopping list of the 15 items we would like to see or on which we would like to work with co-legislators, we have, as I mentioned, only focused on 3, this entering, expanding, and exiting elements, and we really think it's important to focus really on just a few ones, and to start with securitization. It bodes well for the rest, hopefully.
Thea, Virginie, any thoughts that you'd like to?
So picking up on that, I think the pool of investable assets, or the attractive investable projects, I think that's something that we talk about, private-public partnerships, where we go in and we mix the entity participation a little bit. I think we need to look into being a bit more creative on that. But I think it also comes back to the fact that if investors are in the market and looking for projects and they cannot find them in Europe, but they can find them elsewhere, and they have an obligation to deliver return on investment, then we need to look long and hard in, are we actually able to provide the right vehicles for SME scale-up projects? Can we pool enough into bigger funds? So that's where the use of venture capital, for me, I find that personally very, very interesting, or just basically having bigger investment vehicles that can pick up some of these things. You can look to the ECB, you can look to the EIB, there's a lot of also development projects that are going on that I think we need to be a little bit more creative. But private-public partnership, if there's one, I don't know if it's a low-hanging fruit for us, but a lower-hanging fruit, we need to explore that vehicle a lot more.
Enrico Letta has a remark.
No, the question is absolutely...
It's on, I think.
The question is absolutely correct, and the protagonism of member states is absolutely fundamental, as Maria Raffaella Setta just said before. My point is that something is happening from this side, because, for instance, we had this initiative here in Brussels under a Spanish leadership that was interesting some weeks ago, with the big countries involved, so France, Germany, Poland, Italy, the Netherlands, even Luxembourg was there. That was the biggest news, because Luxembourg was there in a, I would say, proactive and positive mood. In my view, that this initiative was a very good signal also to say that if there's not an agreement at 27, there can be an enhanced cooperation initiative. That is, in my view, the only way to convince all the member states to move. Because it is clear that if one country knows that he can use the veto, political veto, because there's no, I would say, formal veto in these topics, but he can use the political veto and the other will stop. Of course, there is another dynamic if you can say that, listen, the 5 big countries, we want to move in any way. That will have a different... I know that there's a France-Spain initiative on savings. They are elaborating something that they will present in the next days, weeks. So something is happening on the side of countries. But of course, we are close to the moment in which the cards will be on the table and the member states have to say what they want to do. It's not easy, but this is the demonstration of the fact that the momentum is there.
Thank you very much. We could take one more short question if there's one in the audience, please. Marcelo.
Yeah, my question goes to Boris on the retail CBDC of the European Central Bank. We are following the process closely. At the level of the Swiss Bankers Association, we believe that the private sector solution to a digital currency is preferable. Reason being that, as you said, you would have to limit the issuance of your central bank retail CBDC at some level, because otherwise, I guess, all depositors, if it was unlimited, could instantly switch their deposits into a retail CBDC in a real time, which would obviously create an enormous threat to the stability of the two-tier banking system. So my question is, if you limit it, who is safeguarding the limit? Who says where it is, how big it is, and who guarantees that it will always stay where it was set?
That's a very timely question, because this is exactly what's being discussed right now. So we are working on a methodology, an objective methodology to set the limits. And for us, it's on our balance sheet, the digital euro. There's also seigniorage. So there is an element which is a central bank money, like cash. So it's also there is a direct link to our monetary policy, meaning that for us the central bank is key in setting these limits, and we are of course also in Brussels. So meaning there are the other stakeholders. So we are working together with them on a way to involve ex ante also the other stakeholders to set this limit, and that's why we work on this objective methodology to find the right threshold and the right level. And so just be a little bit patient, and I'm sure that we will make some further progress this year, in particular with the co-legislators.
Thank you very much. So we have about 3 minutes left on the clock, just enough time for each of you to tell us, please, what you see as the single priority you would most want to be at the top of the EU's financial market agenda over the next 5 years. And I will start with Thea.
In one sentence, getting it done. We have been well, depending on how you count it, we've been looking at capital markets from a technical perspective for more than a decade now. Let's actually have the political courage, and I call on all the policymakers, to get it done.
Boris?
Overarching financial literacy, we know that in Europe it's absolutely indispensable to increase financial literacy. So this, and then I fully agree with Thea. Actually, we have done enough talk now. We all agree. I think that bottom up, top down, everything. Everybody is on the same page. But now, indeed, we have to implement it, to accelerate, and to have results. And that's really also how the ECB wants to contribute, also with technical work and going into the nitty-gritty, because indeed there are some balances to be found.
Virginie?
Well, I will echo what Thea just said. I think now is the time for action. So what we have the role of ambition, that are all very much important, but now we need clear targets. What do we want? Where do we want to be in those 5 years? So clear targets in order to identify how to best get on about them.
Raffaella.
I can only echo what the previous speaker said about the priorities to get the Saving and Investment Union done, moving from talks to action, and to achieve that at the end of this mandate, let's say, or even earlier if possible, we have stronger capital markets where people citizens can build wealth, where companies can finance their business, especially in critical sector for EU priorities, and where with a stronger capital market, the EU is also a stronger player in the geopolitical context.
Thank you very much to all of you for this very, very interesting and wide-ranging discussion. Let's give them a warm round of applause, please.
Thank you for having me.
And now we'll continue our program. And I'm pleased to introduce Jonas Stulz, Head of Asset Management at the Swiss National Bank. Jonas Stulz joined the SNB in 2003 and since then held several key roles, including Head of Portfolio Management and Senior Economist. In his current role, he leads a team of portfolio managers, traders, and investment specialists in both Zurich and Singapore, overseeing the management of the SNB's foreign exchange reserves. Today he will speak to us on the importance of euro-denominated assets in the SNB's FX reserves. And Jonas, thanks a lot for being with us. The floor is yours.
Good morning, ladies and gentlemen. First of all, I would like to thank Swiss Finance Council very much for this kind invitation and giving me the opportunity to speak here. This is certainly a great honor and privilege for me. Although, and here I may allow me to cite one of the, or probably the most famous African statesman of the previous century, I'm not only elevated by this honor and privilege, but I'm also quite humble. Now, why is that? The reason is when I was talking to Ms. Wittmer in preparation for this short presentation, I was actually asked to do two things. First of all, elaborate on the role of the SNB as a reserve manager in relation to European capital markets. That's the easy one, so I can certainly do that. And then the second one was to say a few words, if possible, on the contribution of the SNB to the strengthening of the Savings and Investment Union, which will be the topic of the next panel. So now this second part, that's a bit trickier probably. And the reason is, as you all know, SNB is the central bank of Switzerland, and as a central bank, or in the specific case of SNB, we have a very important but also very arguably quite narrow mandate. So the primary mandate, as you all know, is to guarantee price stability in Switzerland and at the same time make sure that economic conditions develop in an appropriate manner. So That's the most important thing, and everything else, including investment policy, is in a way subordinated or is second tier to that primary mandate. And that's basically what you see on this slide here. When we look or when we think about investment policy at the SNB, there are basically two main principles and then corresponding objectives that we follow. The first of all, I just said, is support of monetary policy. What does that mean? That means basically that our FX reserves, they are here or they must ensure that the SNB has room for maneuver in monetary policy at any time, i.e. that this means we need to be able to increase and to decrease the balance sheet if needed for monetary policy purposes. The objective following that is obviously, that's the reason why we have substantial holdings, and I will come back to that in a minute, in the most liquid asset classes, which are typically, as of today, government bonds. The second principle, subordinated principle of investment policy, is to have a strong balance sheet. By that we mean basically capital preservation, right? So whenever we invest, we think in terms of our investment strategy such that we A, have enough liquidity in the portfolio to be able to maneuver, and then B, to guarantee capital preservation or a strong balance sheet. In order to do that, safety and also return, interestingly, become important objectives. So diversification is certainly the key in that regard. And then also that we do add that we invest not only in very safe and liquid assets like government bonds, but also in some assets in a prudent manner with a risk premia, be it equities, corporate bonds, just to make sure that we improve return in a sufficient manner to guarantee capital preservation. So if we think of these two objectives, like the first one, support of monetary policy, the most immediate impact you can see on this slide, that's basically the evolution of FX reserves of the SNB. And you see we started at before great financial crisis in 2006. FX reserves have been very stable at the level of about 50 billion Swiss francs, more or less US dollars also. And then it increased dramatically in several episodes to reach at the peak in 2022 almost 1 trillion Swiss francs. And the reason, therefore, is purely, simply, there is some valuation effect maybe also, but it's actually monetary policy. So to explain that, what happened between 2008 and 2022, we just had, as Switzerland, as a country, we had several episodes, starting with the great financial crisis, then the subsequent Eurozone crisis, and finally 2020 to 2022 COVID, with arguably market stress, a lot of inflows and appreciation pressure in the Swiss franc, and in an environment where interest rates have been already very, very low, even in negative territory, as you may know in Switzerland. This was a period when SNB needed to intervene repeatedly in the foreign exchange market, i.e. we sell Swiss francs and we buy foreign currency in order to dampen the appreciation of the Swiss franc and in order therefore to dampen also deflationary pressures in Switzerland. So FX reserves, very important in the Swiss case, are clearly first and foremost a derivative of monetary policy. By the way, you can also see from this chart here, it's not only going up, right? If you look at the situation in 2023, the balance sheet also, or FX reserves, were also decreasing a little bit at least. Part of that decrease in 2023 was also valuation, so we had market value losses, but also we kind of reversed the intervention to a certain degree in 2023, simply because then not only SNB, but most global central banks have been in a tightening mode with rising inflation and the need basically to, for once, fight inflationary and not deflationary pressures. What you can also see, by the way, in this chart is that the euro or euro-denominated assets, that's the dark blue part, they have always played and still play a very important role as a part of our FX reserve. So as of today, we have holdings in European assets of roughly almost 300 billion, which is more or less 37% of the overall portfolio. I will come back to the rationale behind that high share in a minute. Now, asset and currency allocation, when we think about the second objective of investment policy, namely the strong balance sheet, this basically calls for a diversified portfolio. And here, I remember the discussion I had with the chairman of the SFC yesterday over dinner. I admit diversification can go much further than it goes with our balance sheet, but I would argue for a central bank, for a reserve manager, not sovereign wealth funds, we are pretty well diversified. So in terms of assets, yes, we do have the dark blue part, 64% is in government bonds. That's bread and butter for central banks. We need that liquidity. But then we also have 11% in other bonds, which is mostly investment-grade corporate bonds, supra-sovereign assets, inflation-linked bonds. And then we have 25% in a global diversified equity portfolio. Corporate bonds, equities, clearly here the ambition is to have to collect risk premia in a way to guarantee the strong balance sheet, the preservation of the capital of SNB. In terms of currencies, we are even more, I would argue, diversified. We have the biggest parts are certainly the dollar and the euro, with both almost 40% of the balance sheet, but then also yen, British pound, Canadian dollar, and a collection of other currencies, just to have a broad-based, diversified portfolio. Now, looking at this picture, and here I come back to the fact why I'm standing here quite humble, right? When it's now the question about what can SNB do or contribute to the strengthening of, say, any foreign capital market. First of all, as I elaborated on, we don't have a direct mandate for that. That's number one. And then also, you might argue, yes, we have a large balance sheet, but if you look at the ingredients, we are only invested in large public markets. So probably even if we had that ambition, our weapons would be quite, maybe not very powerful. Nevertheless, I would argue that we, as a large investor, we are certainly, like our behavior, is certainly in line with, say, a stable, robust, and also sustainable capital market in the European Union. Let me maybe make 3 examples or statements to substantiate that fact. So first of all, as I said, obviously we are a large investor, we are a long-term oriented investor, and we have a very stable and in a way predictable investment behavior, and we are invested, I would say, in the backbone of the European capital markets, be it large European government bonds, be it European equities and corporate bonds. So I would say, or I would hope that as an investor, we are maybe conservative, but we should be very welcomed and also very stable. That's number one. Number two, very importantly, we, especially as a large investor, we care a lot about liquidity and market functionality in the markets where we invest in. So point A, one of our key principles internally is to transact, even if we have sometimes to transact big ticket sizes, always in a market-friendly manner. Market-friendly means for us, we don't want to have direct and visible market impact. We also measure that post-trade very accurately to make sure that we have procedures and protocols in place that guarantee this market friendliness. And second one, we also do certain transactions in order to improve or to help market functioning, especially in government bond markets. Here I think of securities lending programs or reverse repo transactions that we do. Admittedly, it's kind of a win-win. So if we do those transactions, it's kind of a more or less risk-free extra return for us. But then also we are able to give high-value collateral back to the market and thereby contributing to market functioning. That was something that is especially in all the years when ECB, like many other central banks, had large-scale asset purchase programs, and maybe some of you have been familiar with that concept of collateral scarcity, for instance, in German government bonds. So there we had certainly an important role, not to completely solve those scarcity issues, but to kind of provide some relief to the market. Third aspect, we also, SMB takes into consideration non-financial aspects in a limited way in our investment behavior. So for instance, we do execute voting rights for our equity holdings in European companies, small cap and mid and large cap companies, where we vote basically for governance issues, with the idea that we say good governance is certainly beneficial to at the end of the day, to the market value of those companies. So we here do our contribution in that part. And then also you may have heard about that. We follow an exclusion list where we basically have the idea to say we do not invest in any products or companies that use production manners that are against some very basic and common norms and values of Switzerland. And by the way, I would argue that's probably these norms and values are pretty similar in Europe in general. So for instance, we do not invest in companies that are involved in severe violation of human rights, in severe damage, environmental damage, and we do also not invest in companies that are involved in the production of internationally condemned weapons. So all of that, I would say, is maybe not a direct contribution to the function, to the competitiveness of the SIU, but certainly as an investment behavior in line with a stable and robust, sustainable capital market. Now, let me come back maybe in the last 2 or 3 minutes to our euro investments. As I said before, we invest roughly almost 40% of our reserves in euro-denominated assets. And apart from the US dollar, that's clearly the most important part of the portfolio. The US dollar, we know everybody, that's the reserve currency number 1 still in the world. So there is also for liquidity reasons, it's pretty clear why we are invested there. But for the euro, basically, or generally for currencies, we follow the following 5 criteria when we determine our currency allocation. And quite frankly, the euro ticks the box for pretty much, or for literally all of them. First of it is economic importance for Switzerland, right? And no doubt, European Union is the most important trading partner of Switzerland. I guess if I can trust my numbers here, in 2023, 50% of all, or let me see whether I have it correct. 50%, yes, of all goods export went to the EU, and even 70% of imports came from the EU. So certainly the European Union is the most important trading partner for us. Second is liquidity of the currency. Here again, the euro, after the US dollar, is the most traded currency in the world. I think it's roughly in every third FX transaction in the world, the euro is included. And also the euro is, according to IMF data, clearly the second most important reserve currency in the world. Third, very important for us, given the size of the balance sheet that we run, size and liquidity of investable markets. I said we are highly dependent on liquidity, so we are more or less forced to park a lot of our money in government bonds. And here, for instance, the German government bond market is, as of today, still by far, I would guess, the biggest AAA-rated government bond market in the world. Then also credit risk and governance. Most European assets that we are invested in feature good governance criteria. Credit risk, we know we had episodes where there was an issue with the credit risk, especially in some more peripheral European governments, but also relative to, as of today, to the rest of the world, we feel very, or pretty comfortable with those investments generally in the European government bond markets, and also the euro features some nice properties, or some decent properties, I would say, in our portfolio context. So these are basically the reasons why we as Swiss, and probably that's not a surprise, have a high bias in our investments to European assets. So now I'm pretty much at the end of my presentation. I hope I could demonstrate USMB is a very large, very reliable investor in European, not only government bond, but European asset markets. SMB does not have a direct, neither explicit or implicit mandate to contribute to competitiveness or strengthening of any foreign capital markets. But it goes without saying that the SNB, as the central bank of a small open economy that is surrounded by European members, is clearly very much interested in the success of any endeavors to strengthen the savings and investment union in the European Union. So with that, I'm very keen to hear the statements from the next panel, and I thank you very much.
Thank you very much to Jonas Stutz for that compelling reminder of the degree of interconnectedness between the EU and not only Switzerland, but also other neighboring countries. And that degree of interconnectedness means that third countries are already providing Europe with a great deal of capital, expertise, financial innovation, and that a lot more can be done to enhance cross-border investments as well as to strengthen integration. And we talked a bit about that in our first panel. Now we want to do a deeper dive in a panel entitled Bridging Borders, Third Countries' Role in Strengthening the Savings and Investment Union. We have a group of leading stakeholders with us to explore how we can more effectively unlock this cooperation, and I will keep the introductions brief and ask them to join me as I read off their names. It's a pleasure to welcome Christa Rondu de Lint. She is co-CEO of Vontobel for the past 4 years. Prior to that, she held leading positions in financial institutions in the UK as well as in Switzerland. So welcome to you, and you can take that seat right there if you would. It's also a pleasure to welcome Lucas Gevila. He is Vice Chairman of the Board of Directors of the UBS Group. He previously held leading posts at Credit Suisse in North America and in Switzerland. And if you would take the seat in the middle, that would be great. I'm pleased to invite William Wright to the stage. We heard from him a little bit earlier during our Q&A session. He's founder and managing director of the think tank New Financial, which was created in 2014 and dedicated to fostering bigger and better European capital markets and a reboot of UK markets. Welcome to you. You can please take the seat next to Lucas. And finally, a pleasure to welcome Andreas Schwab, member of the European Parliament for Germany's Christian Democratic Party. And you sit on the Committee on the Internal Market and Consumer Protection. Welcome to you, Andreas Schwab. So let's start out by talking about the potential contributions of third countries. And I'd like to begin with an outside perspective on the significance of the Savings and Investment Union initiative and ask each of you to share your vision of what partnerships can do to enhance Europe's financial resilience and competitiveness. And I'll start with Crystal and ask you how Vontobel sees the Savings and Investment Union.
Well, I think, I'll broaden a bit in the sense you asked the question, the role that third countries can play in strengthening the savings and investment unions. And I think the role that third countries can play is by being partners. But being partners mean, in my mind, 3 things, is to be aligned in the values, ambition, to be reliable, and to bring something to the table. Aligned, I trust we are, historically, from our values, We have an external force in the US that keeps us aligned. Being reliable in the context of financial markets means having a stable political system, having a stable regulatory framework. I actually think on that side, for better or worse, time will tell, the EU should not fear that Switzerland will wildly deregulate. Let me put it this way. So from that perspective, we shall be reliable. And then bring something to the table, quite naturally, if you want to be partner, is what's in it for me, and that is a legitimate question. So let me just say, we are already, and you asked, and that's where I'm going to go into also after that from the Vontobel part, but we are already partnering with the EUs in many ways. So when you look at the asset management industry, over 10% of the fund, the Luxembourg domiciled fund, are actually from Swiss asset managers. That does certainly create business for Luxembourg, but beyond that, because we place our investment teams in Europe, those investment teams, if they manage European-based products, will invest in those assets. So that's what's already there. What's at the doorsteps of Europe, I'll let Laurent elaborate on that, but there is a huge pool of ultra-high net worth money that cannot be deployed into Europe and would absolutely wish to be deployed in Europe. That's what's out there and could be brought to the table. And what's half there, and that is a huge need in the saving and investment union, is all the part of the infrastructure investment that is needed across the board. Even if we had first best infrastructure, digitalization, demographics, decarbonization means the needs are huge. Now, I'll give you the Vontobel example. A Swiss firm acquired a significant minority stake in a private infrastructure player based in the UK, so Swiss, UK, 2/3 countries, players. What does Ancala do? They invest in infrastructure in Europe. One of the investments is that they are actually involved with the largest smart meter companies in Germany. Now, this is very much needed, but it's on a small scale. It's on a small scale. And for Europe, it's just a fact. It's not a judgment, but it's a fact. The infrastructure players are not at the moment in Europe. They are in the US. The UK happens to have one, and Switzerland happens to have one. So bringing skills to the table shouldn't be a taboo. It's a good thing. So that's the role, I think, that can be played.
Let me ask you a very brief follow-up question, because you talked about partnerships and you talked about alignment. Would you say that there are best practices when it comes to the financial ecosystem in Switzerland from which the EU could learn, humbly?
Yeah, well, there was, and I hope they'll stick. Self-regulation is one of them, very pragmatic. So I hope that continues as well in Switzerland, but that is definitely something that has worked well and that can be looked at. Principle-based as opposed to rule-based, we've heard that this morning, and I think this were in our best practice. And of course, in the context of Switzerland and EU or UK and EU, as a matter of fact, there are already precedent with the US of entities being doubly regulated, so both by the SEC as well as by the FINMA, and that works. There are teething problems as you set it up, but it does work.
Thank you. And Lucas Gabriel, staying with the partnership topic, and from your point of view as a global and Swiss banking leader, how does UBS see this strategic potential in the partnership between third countries and the EU?
Well, I think if we actually move a little bit now to the macro level, you mentioned the strategic part of it. I think both partners, the EU and Switzerland, in a way are very complementary. And we have been in Brussels since yesterday as the Swiss Finance Council, and we've been visiting various stakeholders. And we keep realizing that this letter report, the Draghi report, and we heard Enrico earlier this morning, are still mentioned very frequently as almost a guiding principle for the way forward. And if you look actually at the big picture, and the Draghi reports actually says that, and you mentioned this, Crystal, the EU has to invest into demographic challenges, into digital assets, into the energy transformation, now also defense. They would need about 800 billion to almost $1 trillion yearly to fund all of this. And then, if you look at Switzerland, on the other hand, you actually have a pot of large assets that need to be deployed. And I would like actually to include the UK in this. Switzerland has about 9 trillion of euro assets under management. The UK has maybe even more, so together it's overall exceeding 20 trillion of euros in 2 major financial centers that are part of Europe, sitting in Europe, but not being part of the European Union. And actually to fully exploit these joint forces would be a primary goal going forward. Because, listen, we have increasingly clients who actually ask, are there not more investment opportunities into Europe? I mean, given the recent political changes, and we look at, for instance, equity allocation in our portfolios, still 65% are almost allocated to the US market. And people increasingly don't feel comfortable with that. So there is huge pots of actually funds available. And, as I can only reinforce what Crystal said, Switzerland, Switzerland doesn't have a lot. We have a lot of mountains. We have a lot of good universities. We have some pharmaceutical companies. But in the end, we understand services, and banking is one of it. And therefore, we have a heritage of about 150 years of, innovating products, enlarging products and services. And we would be more than welcome to give access to the EU to all these funds.
And I want to come back to that point later on in our second round of discussion, but a very quick follow-up now, if I may, because one of the things we talked about in the last panel was the role of trust. And yes, these are neighboring regions, countries, and at the same time, there are sometimes trust issues involved. So what would you see as key enablers for building trust and long-term collaboration between the EU and Switzerland?
I'm not sure whether it's the trust that's missing. I think it's more the infrastructure that is missing. When I'm talking about infrastructure, it's also, we have very fragmented regulation. We don't really have open market access. We perceive, I'm not saying it is, we perceive the EU more inward looking. And that then creates maybe the sense of mistrust. So if we actually came all sides together, and I'm not just advocating for Switzerland, more third countries in general, and that's why I included the UK beforehand, is let's bear down barriers, make markets more homogeneous, get the regulatory requirements more aligned. We would even be willing, as Swiss financial institution, to comply with EU rules in a cross-border case, but they need to be semi-practical. Yeah. So clients actually do want to invest.
We're going to come back to that a little bit later on, and of course you're picking up on what we heard from Marcel Rona at the very beginning of this event. Let's dig deeper on some of those regulatory issues that were just mentioned by Lucas and William. From your own point of view, and you've been working in this area now since 2014, looking at the challenges, what would you say are the common challenges that are faced by EU and third country financial firms and investors, especially in areas like retail investment participation, access to finance, and especially regulatory alignment?
Thank you. And let's set aside the geopolitical challenges, because I don't think any of us know what's going to happen by the time we get out of this. By the time we come out of this conference, let's focus on some of the sort of regulatory issues. What's really striking to me from a UK perspective, and I'm representing the UK perspective on this discussion, is the convergence in the reform agendas over the past 5 years. In the first 5 years after the Brexit referendum, most of the debate was hijacked by the discussion on relative competitiveness, relocation, equivalence, what needed to be done onshore in the EU, what could still be done from London, so on, so on, so on. But what's really shifted in the last couple of years is that the EU and UK in most areas are looking at the same problems, reviewing the same regulations for the same reasons, coming often to the same broad conclusions, and even broadly the same solutions, just with slightly different, slightly different priorities, structures, and timelines. So there's sort of a degree of copying each other's homework or shadow boxing. And just to give an indication, I mean, we have in the UK, we had the listings review by Lord Hill, the former European Commissioner. The EU has the Listing Act. We're both looking at Basel III, Solvency II, which has become this sort of horrible Solvency UK in the UK regulatory debate. We have LTAFs, long-term asset funds, which we've designed to try and replicate LTIFs, so to try and encourage more investment in private markets. We're both looking at variations of a consolidated tape. The UK, Switzerland, Germany, looking at different variations on a separate regime for smaller banks. Mm-hmm. So it's the same debate, and we're in each other's backyard, and there have to be ways of working more closely together. But I mean, a couple of challenges that come with that. Colin mentioned this morning that Pascal Donohoe last year made it very clear, sorry guys, you're third countries. Now the world has changed, but we're still third countries. Yeah. And we're seeing that right now. There's the UK-EU summit coming up on Monday, and if you look in the FT or on social media, you'll see that we're arguing again about fish or about youth mobility because we're a third country. This is complicated stuff, and we have to engage with the structures of the EU. Bigger challenge, I think, is the political climate back in the UK. We have a relatively new government. This is not a political statement, I think, to say that it's been relatively timid in its thinking about the EU. It is terrified of a big constituency in the UK which sees any closer cooperation, however technical, with the EU as some sort of betrayal of Brexit. It's the Reform Party, parts of what's left of the Conservative Party, and some of the powerful media. And that is a real blockage, There's almost a similar issue with coming from the EU side, that Brexit was a really bruising experience.
Yeah. It's a great paradox, though, that in fact, it goes in that direction and not the other one. But that's just, again, from an outside point of view. So, and forgive me for commenting, but yeah. In many ways, what we're seeing in terms of the reshaping of the EU vision, and it goes beyond SIU, really, doesn't it? It goes toward making Europe a more vital, potent geopolitical actor as a whole. And that essentially is about changing that EU project from being inward-looking, as I think Lucas said, to being outward-looking. So, Andreas, and I've on purpose saved the European point of view for the last one, so to speak, or the EU point of view for the last one. What is the European Parliament's vision for deepening cooperation with third countries, including in financial matters, but not only? Because I think it's clear to Europe that this is a challenge that can only be met through cooperation.
Well, thank you so much for the question and for the invitation. I think it's amazing that you are all here this morning to discuss about these amazing and interesting questions. I would say, first of all, I can't speak on behalf of the European Parliament because there are 719 colleagues that have all a bit different views, and most of them are not really interested in financial markets. So, to start with this, I would like to say that there is the world, and the world is broken. There is the European Union, amazingly stable, strong. And there are those countries that you mentioned as third countries that, on the one hand side, have decided, unfortunately, to leave the European Union. And on the other side, unfortunately, although being in the middle of Europe, have not dared to join. And now we see it in a certain way as an excellent opportunity in that debate for both of these third countries to understand how brilliant the European Union is helping them to keep the stability in the worldwide disorder. Yeah. That's the official trailer in favor of the European project, in favor of the European Union. But we have for sure the problem that the projects that are ahead of us are very big. We have been discussing with Lucas and all the colleagues here yesterday already. We need urgently investment into projects that we are not able to invest fully ourselves for different reasons. It's probably less a problem of capital markets, it's a problem of political commitment, but still the result is the same. We need investment. And I think you have been, Lucas, you have been mentioning some of the numbers. I think the best example is that, for example, on the big project that is at the moment at the heart of the discussion, this European Defence Union, or let's put it in a more blunt way, the need to invest into defence material. For example, we are having in the budget for the European Union from 21 to 27, we have 16.5 billion euros that are invested in research in that area, and there is not so much math needed. This is far too little. Yeah. So there are amazing investment opportunities, and we want, and that's the second project, we want to motivate private investors to invest more into this. Now, private investors are like normal investors. There are good ones and bad ones, and there is for sure some sort of feeling with the European member states, with the European Commission, and I would say the same in the European Parliament, that we want to provide a system that avoids that the good risks go to these third countries and the bad risks stay with us. That might be the overarching emotional concern that this debate is linked to. And therefore, I don't see an easy way out to open up markets, as it has been mentioned here or alluded to here. But I think the UK government is doing step by step, also because the decision to leave the European Union has been found in the larger public as rather a mistake, that step to stabilize this relation. I think that the Swiss federal government is about to go for that next step in bilaterals, and I think step by step we will get there. I unfortunately fear that the Swiss friends here in the room, they will not be happy with that a midterm assessment that I'm doing here, but I would say everything else is a bit too optimistic, and therefore I would say let's do step by step, and let's make an assessment in Switzerland and in the UK about how much stability the European Union offers, also for investors. And at the same time, let's argue with Europeans how interesting this investment could be that comes from very close neighboring countries that have a lot of, a big pot, as Lucas has said.
Yeah, please.
Sorry. By the way, these investors, Andreas, you're relating to, very often these are European investors. Mm-hmm. They might just hold their assets offshore for some reason, not in the European Union, but they're actually interested in investing into the European Union, actually much more than for instance, Asian investor or so.
Right. One very quick follow-up with the request for a super short answer to it, but you told us at the beginning 798 different opinions within the European Parliament.
719.
19, okay. Nonetheless, that's a lot. Would you nonetheless say, and actually I kind of implied an assumption about this, but I'd like to hear your opinion, would you nonetheless say there is a sort of a groundswell consensus due to the geopolitical environment that we're in that change is needed and that an outward-facing EU is an important goal?
I would say that there is a clear assessment that what we have been believing in the last 20 years is about to be shaped and to be changed, but I don't see yet a clear common commitment on where this should go. There are some that are rather preferring an inward-looking model, protecting the European Union against third country intrusion. And there are others that see that this won't make the deal for our future. But we haven't seen already clear proposals on where the larger political landscape in Europe is going. That's my personal assessment.
Thank you. Now let's take a deeper dive on the practical dimensions of integrating third country capital into EU markets and ask how we can more effectively tackle some of the barriers to doing that. And Lucas, if I could start with a slightly provocative question, because, and in a way you just mentioned this now in your remark to Andreas, why is it important for UBS to talk about market access and improving, enabling frameworks for cross-border investment when, in fact, you have many branches and subsidiaries in the EU that are already doing the interaction?
Well, that's a very good and frequently asked question, by the way. I mean, I'm not just talking about UBS sitting on this chair, but because UBS probably has a certain scale and obviously can be onshore in these markets. We have a lot of very good, very successful private banks, asset managers in Switzerland that are primarily also having the strategy on, having booking centers in Switzerland, because having booking centers all over the world would be now very cost effective. At the same time, I'm always surprised that our client, and that's when I talk about UBS, is the driving force. We do what clients want and need. And there is a big need for them to use different booking centers. And it doesn't really matter whether it's European client, Asian clients, North American clients. In the ultra space, very often they have several booking centers. And there is a reason why they still want to have a major investment in Switzerland, be it for stability reason, be it political, be it currency, be it actually regulatory, so far at least. And therefore, I think it needs both parts. And if we want to make the EU market and the Saving and Investments Union as effective and productive as possible, it should go both ways.
Mm-hmm. So what precisely is needed then to really make this market access work so effectively that that enormous pool can be tapped by the EU?
Well, obviously, I guess the challenge of Europe is a little bit more complex than just granting market access to third countries. Obviously that's the easiest thing from our seat, because obviously we have a vested interest in providing our clients with the best products and services. But I think the EU has to go down several avenues, because there's the supply side and then there is the demand side. And obviously the most important one, if we would be granted access to the European market, is that you have an alignment in regulatory framework. But if I listen to Enrico this morning, he has 27. I'm actually rather looking at the 28th, which could be the passport too, as he mentioned, to have an access and then to plug it in. So regulatory fragmentation is probably the biggest obstacle in a way to do business. But even third countries would be willing to say, we fully adopt in a cross-border business, we fully adopt the EU rules, and you can come and do reviews, audits. So I think we have this, I think Marcel mentioned it this morning as well, this institutional-based approach, where we will be actually very open in terms of how can we engage easiest. But you're absolutely right. Obviously, Europe, and I'm far away from giving Europe advice, because being Swiss, I know how sensitive these issues can be. But I mean,
British.
creating an investment environment for companies to to thrive is very important, be it on a tax basis, be it on a labor law basis. I mean, I have a lot of German entrepreneurs, I know, and when they talk about, how regulatory mushrooming has been going on over the last years, it's really unfortunate. And then I think the third avenue Europe needs to go down, it was mentioned on the last panel, is more the cultural issue. And we were actually talking yesterday about it, and we were asked what could we do if we had one wish, and then Colm Keller actually mentioned that, bring a culture in and incentivizing equity holdings as the Sweden has done it, would be an avenue to go down to. So it's a whole potpourri. If you look at market access, we certainly would be prepared and willing and excited to play our role, but obviously we cannot influence everything, and it's only one part of several avenues the EU has to pursue.
Thank you. And that third point, I think that was covered also in the last panel, and it was very interesting what Boris had to say. That, that was his top priority, number one, that he thinks needs to be done to create that new mindset, basically. Crystal, you also talked about the market access and picked up on Marcelona's suggestion. But beyond that, what role would you say that third country asset managers can play here to really enhance cross-border interaction and also provide that additional market liquidity?
Yeah, I think it's your last point is enhancing market liquidity, enhancing market depth. In a sense, when you look this side of the century, the US and European economy were the same size. It's now, Europe is 2/3 of the US. Early 2000, the stock markets were the same size. Europe is now 20%. And I'd like to say, it's the money, stupid. It's capital market. That's what it is. It was to Enrico Letta's point, let's make the banks, let's make the financial system for the real economy. We have to do a better job at explaining that. It is for the real economy. What else? What else do we do as a financial system? That's what it does. So this is exactly how we can contribute. And I do hope indeed, and it would be almost like, it's strange, Andreas, but I hear that saying, in a sense, what if the good risk goes to the third countries and Europe is left with the bad risk? But that is almost saying we've lost already. So let's not let it be that, because it means if the good risk comes to the UK and Switzerland, then we advanced. But I'd like to think, no, this is not that. It's just it hasn't been opened up. It hasn't been shared. And while Switzerland will tell you small is beautiful, in the context of capital markets, it's about breadth, it's about depth, it's about size.
William, on the basis of the research that you have done at New Financial, what policy reforms or structural changes would you say are also top priority in order to attract foreign long-term investment and also develop more dynamic markets?
How long have we got?
Not long, actually.
I think the first point, it's not strictly a regulatory reform, it's a shift in mindset. There's been a lot of discussion about shifting the mindset around risk culture and retail investors. I'm talking about a shift in mindset at an institutional regulatory policymaker level. I want you to, I'm sure many people in the room, like me, enjoyed reading the very first white paper on Capital Markets Union back in 2015. On page 2 here are some bullet points of the aims of CMU. And the second bullet point in the very first paper outlining this vision for CMU was to help make Europe a more attractive investment destination for investors from around the world. Now, that sort of disappeared post-Brexit and in subsequent iterations of Capital Markets Union. And there was a real, I think, a very valid sense that while the EU was focusing on trying to remove barriers between markets in the EU, it was gradually erecting them around the outside of the EU. And I think that absolutely requires a sort of shift in mindset, which, courtesy of some of what's going on in the US, on our doorstep in Ukraine, is being encouraged. That there has to be a rethink as to Europe's openness to this sort of capital. I mean, to an extent, capital will flow like water to wherever the best investment opportunities are. We've seen a massive increase in the past 10 years in venture capital, early stage investment, much of that coming from US VC funds. But the structure of the European economy, the shortcomings of the single market, I mean, I think Draghi said that they amount to a tariff rate of 110%, given the barriers that exist in the real economy between individual member states. That sets the hurdle, sets the bar so high for for European investors, but particularly for a non-EU investor, to make a decision to invest in project A in that member state over there when the returns are, that company has got to do extraordinarily well against very high regulatory, legal, social barriers, that it might just be easier, as Enrico Letta said this morning, Europe's too complicated, let's move on.
Thank you. Andreas, building on what we've heard here from the preceding speakers, but also on your work, what would you say are the kind of institutional or political frameworks that we need to improve cooperation across borders? And also, if you could pick up on some of the points that have been made about equivalence assessments and the role that they could play in such an effort.
Well, let's maybe start with the limits of this capital markets union that William was just mentioning, which has now got a new name, which is Savings and Investment Union. And I mean, language matters in politics. Mm-hmm. You may remember that when Charlie McCreevy was pushing forward the Services Directive, he was all the time referred in France to the Bolkestein Directive, because this was, as an expression, much worse than McCreevy. The wording counts, and I think capital markets in some countries are not at all seen as positive elements, and so savings and investment might be better. I don't know why the title has changed, but language matters. Secondly, the European Union is unfortunately bound by the principle that is coming most of all from the member states, that the best would be that nothing changes. So a very good example out of the context of that capital markets union, the insolvency law, has therefore been failing more or less, because such a law would go very deeply in the member states' existing legal frameworks. And if you don't manage to change it all over the place, there is no harmonization, and therefore there is that idea of going for a 28 regime, which is for sure inviting to for the fast movers, new effects. There is also a risk of forum shopping, because if you have a 28 regime for insolvency law, then it will only remain with the legal professionals and the courts to speed up even further. And that may lead to a situation where, for example, I make a bit of a strange example, that, for example, Malta will be the highest density, will have the highest density of insolvency laws, because the courts there get the boost from the government, and they are deciding everything very quickly. And that's what member states of the European Union will definitely not want. And by the way, the 28 regime on company law was Ms. von der Leyen from Germany pushing back in 2011, 2012, I don't remember anymore the year. So it's more complicated than this. My advice would therefore be, and we have been discussing also about this yesterday already, that we find areas where the regulatory effect is not that deep at large, but is limited on an area where the European policy making is predominant. There are such areas, and we can...
Can you give us an example?
Yeah, we were discussing about securitization as an element, really banking, limited to banking law changes that can help. But they will not create that savings and investment unit that is alluded to here. They will just be little steps forward. But that's at the moment probably the most likely thing to operate. And then Crystal was right, no, also you were both, Lucas and Crystal, rightly mentioning that a lot of investors that are putting their assets in your hands are from the European Union. But that's exactly the reason why the first rule that nothing should change is coming back, because let's take a government, do you have an idea? Let's take the French government, just as an example. They definitely don't want French people to put their assets into Switzerland and to have the better return on investment compared to France. And now the point that you made, is there not a risk for the European Union to end up only with the bad risk and losing all the good risks? Yes, but in politics, unfortunately, I don't want to be superficial, but I think it's also a bit too technical if I don't say it like that. Only if the problem reaches out to a large number of people personally, you can change something. So if there is no feeling that there is a need for change in the public, politicians are not really in an easy situation to push for that. And I don't know your assessment. Maybe you have new financial investigations being done. I don't see, by the way, not even in Switzerland, I don't see in the European Union any push in the larger public for change, except from that investment that is needed for defense. No one wants to pay for it, but it has to be paid. So there will be some sort of need there. And I think in Germany, you know all the issues about car manufacturing and so on. In France, maybe other. In Spain, there is a large assessment which is very much national by the public, but there is a need that is growing. The question here is, has it grown already that far that this equalization, equal assessment of rules between third countries and Europe is already on the cards, or it's still too far? But on that point, I don't want to make a clear comment here because I don't know.
So I had two comments, William first and then Lucas. And if I can just say, William, on this question of where is public opinion, sometimes it takes leadership to move public opinion to where we perhaps have perceived that it would be important to go.
Yeah, we've learned in the UK in the last 10 years that leadership can take public opinion in the wrong direction. I'm not representing the UK government or the City of London, I should just stress. I think there is nobody protesting in France right now for pensions reform, for more capital markets. There's nobody protesting in Berlin for better access for Swiss or UK financial services firms to the EU market. And there is a real fear, I think, in the EU. It's a legacy of Brexit. There is still a hangover sense that Brexit was an exercise in deregulation and that the city wants to steal as much of your business as it possibly can. And that when London and the UK turn up and say, we'd like to help, what a lot of people in the EU will hear is, we'd like to steal all of your business and bring it back to London. So this comes back to these fundamental challenges. It's going to take years to rebuild this trust, but we have to start now, and it does require some leadership. From a UK perspective, let's see what happens on Monday with the UK-EU summit, and that could be an important first step.
The hopes are high.
Sorry?
The hopes are high.
I've learned in this debate to set your expectations low and then hopefully not be too disappointed when you fail to meet those, rather than to raise them any higher.
Lucas.
Maybe I would just like to address one last thing, that's the return question. I mean, Andreas, you mentioned, good risk, bad risks, and that kind of implies, who benefits more, who benefits less. And we actually heard Boris earlier this morning talking about the deposit to financial asset ratio, 10 trillion in the US, and if that would be redirected on an annual basis in European terms, it would be 350 billion. There's in the Draghi report actually very good comparisons. The Crowder report actually shows between 2000 and 2023, the US households, as a result of not having just 10 trillion in asset and sitting there and don't know what to do with that, they achieved a return of over 150%. And in the EU, it was barely 50%. Or the other number that actually I wrote down is, in Switzerland as other countries too, more the Nordic countries in Europe, they have a very professionally built out pension fund scheme. And if you look actually at the return profile of these pension funds, and I only have the numbers unfortunately for Switzerland, between 2004 and 2024, the last 10 years, and everyone contributes, the employee contributes, the employer contributes, and then you have the contribution of the market. The market contribution to overall performance exceeded both employer and employee contribution. So it's not just about good or bad risks, it's if it's transparent, it's a competitive market environment that will yield the best returns.
Mm-hmm. Thank you. Christo.
I just wanted to react on what you said, William, saying the population is not asking for a different pension or for the saving and investment union. But if we ask the question differently, and we ask, in any country, would you like more growth? Would you like your country to actually have the largest company in the world? Would you like your country to be a tech innovator? Mm-hmm. Everyone would say yes. And then you ask the next question. So how do we get there? No one knows. And that means, but we do know that capital markets play a large role in that. And that means we've done a very lousy job at explaining why it matters, why the capital market, the banks, the financial industry is for the real economy. And I think let's try and bring that point home, because actually it is out there. The pressure that we see, all the nationalistic pressures across the world, is the sign of we don't feel quite that good anymore. We're not growing quite that fast. We're the first generation that is not richer than the previous generation. Mm-hmm. And so what do? Up we go like that. But no, if we actually manage to explain that this is not the way to go, then we might have a chance. But yeah, right now no one will come to Saving and Investment Union as the first stop to that journey, but it might actually be.
I was thinking also, as you spoke, that in fact young innovators who are looking for capital and wind up having to fly over to California from Berlin because they're not finding it here. They are, in a way, sometimes voting with their feet. Occasionally, they'll say, I don't want to do it, but we're thinking of leaving. And that is certainly also a form of pressure, even if it's not yet crystallized into something that they could voice as we need SIU.
Yes.
So I think that's a great note to end on. We have 0 on the clock. So I just want to say, sorry, dear audience, we won't take questions in this one, but we'll be going to a lunch break after the next speech, the closing speech, and then you can perhaps find our panelists to speak to them directly. Let's give them a very warm round of applause.
Thank you.
Thank you. And with that, we do in fact come almost to the end of this year's annual meeting of the Swiss Finance Council. It is my great pleasure to hand over for closing remarks to Laurent Ramsey. He's managing partner at the Swiss multinational investment firm and private bank, the Pictet Group, and he also serves on the board of the Asset Management Association of Switzerland. The floor is yours, dear Laurent, please.
Thank you. Distinguished speakers and participants, ladies and gentlemen, as we come to a close to this Swiss Finance Council Annual Conference, I would like to thank our distinguished speakers and all of you for joining us today. But before I try to wrap up, I cannot resist to go off script a little bit and tell you an anecdote which doesn't have much to do with what we've discussed today, but illustrates quite well how excessive regulation can sometimes lead to a complete lack of common sense when it reaches the final consumer. 2 days ago, My wife asked me to go and buy a picture frame she put aside in a shop for a birthday we were attending that night. She put that frame under her name. Going to that shop, and I'm faced with this very knowledgeable salesperson. I gave my name, asked to see the picture frame to buy it, and she tells me, "I'm sorry, sir, I cannot show you the picture frame." And I'm asking why, and she says, "Because it's under your wife's name. And under GDPR, I'm not allowed to show you the picture frame." So I said, "So what do we do?" She said, "I need a written power of attorney from your wife so I can show you the picture frame." So needless to say, true story, needless to say, I didn't buy the picture frame. And that in turn, when I reached home empty-handed, created some problems for me. So the conclusion of this anecdote is that excessive regulation sometimes can be bad for consumption, bad for businesses, and also bad for household social harmony. Now let's go back to the topic of the day. The theme of this conference was building competitive capital markets for Europe economic growth and resilience. This theme was decided months ago, before the recent tariff turmoil unfolded. I think it is even more relevant today and probably one of the most pertinent topics for Europe right now, and I would argue also for the rest of the world. Not only because it is a risk, like much of what has come from the US administration, but because it is also a massive opportunity. Why? The US talks about trade imbalances, a trade deficit that needs to be fixed. But what they don't talk about is the investment imbalance, the investment surplus they benefit from. Today, the difference between what international investors, so non-US investors, invest in the US market, equities or bonds, and what US investors invest internationally is north of $25 trillion. So investors from all over the world are massively over-invested in the largest economy. And this imbalance is probably at or around an all-time high, driven by the historical ability of the US to attract foreign capital to finance its debts and fuel its innovative economy. A safe haven currency and deep capital markets are some of the key elements behind this investment surplus. International investors, private and institutional, now need a viable, reliable, and robust alternative to the US. I've just come back from Canada and Asia, and there is a crying need to diversify away from that built-up surplus. So Europe should not focus only on ways to keep European savings in Europe, which is a narrow strategy, I would argue, but rather to become competitive, buoyant, open, and deep to attract global savings. This is a unique opportunity for the EU to move forward with a deeper capital market integration, not only for the benefit of European investors, but also to attract the wider international investors community. The recent outperformance of European equity markets, as well as the strengths of euro, are short-term catalysts for some of this reallocation, but longer term, there are structural factors Europe must address for its own benefit. As international investors move some of their 25 trillions of overinvestments elsewhere, they have options. Europe is not the only destination. Japan, developed Asia, and many emerging markets are also attractive. So if we, and I use we consciously, to mean greater Europe, including Switzerland, including the UK, if we want to benefit from this change in flows, then we need to act. Because today European markets are fragmented, as we've heard, and as a result, lack the depth to sustainably attract long-term savings. What is needed, and here this conference has given me some optimism, I've moved some hope to optimism, especially the remark of former Prime Minister Letta, is a single integrated financial market combined with significant simplification of regulation. The 28th regime outlined by Mr. Letta in this report could be a catalyst to ease access of more international investments into Europe. This would also give European savers more choice to invest their savings efficiently. What the EU is proposing with the Savings and Investments Union is definitely going into the right direction. But we think there is a need to act swiftly with a greater sense of urgency to grasp this opportunity and great intentions into concrete, fast-paced actions. So what's the role of Switzerland in this development? One of the Commission's 7 priorities until 2029 is to create, and I quote, a global Europe, focusing on our wider neighborhoods to promote peace, partnership, and economic stability. This wider Europe holds savings that could be further deployed in the EU, provided the right framework is in place. Switzerland wants to be a strategic, reliable, and stable neighbor and partner in this endeavor. We would like to direct more investment to a more integrated and, as a result, deeper EU capital markets, and we would like to bring more of our expertise to Europe. This also requires, as we've heard, more simplification, and the plans for a savings and investment union indicate, and I quote, efficient supervision in the single market is needed, with actors receiving the same supervisory treatments regardless of location in the EU. For Swiss firms acting cross-border and holding substantial amounts of savings for EU citizens, this could mean single market access with one EU-level license per institution, what we call the institution-specific approach, with voluntary submission to all relevant EU regulations. The 28th regime of Mr. Letta could be a framework used to accomplish this access. Switzerland holds 2.8 trillion of cross-border assets. It is estimated that 1.12 trillion of those assets belong to EU citizens, and approximately half of that is not embedded in a framework that allows us to activate that pool of savings to redeploy in the European market. The Swiss finance industry, with its expertise and substantial global assets sourced from international clients, can be of more benefit to the EU. The Swiss finance industry and its clients need a strong, more integrated and deeper European capital markets in order to funnel more of the saving pool it controls to the continent. So we hope that a constructive dialogue can continue to strengthen the partnership we have, where both Europe and Switzerland can benefit from a wider and more open market. So as Europe looks at directing more savings towards investments to finance its economy, don't just aim at domestic savings, but also look at available global pools of capital. Let's make Europe great again. With that, let me close by thanking Esther and the whole team in Brussels for organizing this great conference. Since 2015, the SFC conferences have brought together policymakers and the financial industry at the European, Swiss, and international level. It's been a great pleasure, and we look forward to having this conference again next year. And with that, we're looking forward to continue the conversation over lunch. Thank you very much.